Change stock options trading journey. And today, this terrific Thursday, January the 29th, I want to thank you for tuning in and being in the building. Well, yesterday was definitely quite eventful. Having FOMC, I decided not to trade. I didn't see any reason to put any money foolishly at risk. So I'm glad many of you did not either. Nonetheless, we are ready to go. Let's ready to rock and roll today as we have showed up, and we'll allow the market to show us what it is thinking, and then we will formulate a plan from there. Okay. Very important area that we're in right now. Todd Macon, shout out to you, buddy. Very important area we in. Yesterday, the only trade came at 10 o'clock, and that was a put. That was the only safe money trade. That put, if you was strong enough to hold it to the 695, you did good. And you were done before Powell even spoke. That was the early trade that the market gave yesterday morning, and that was it. A gap from the 697, a scalp from the 697 to the 695. That was that sure money put yesterday. Quiet soul in the building. I didn't see any need to put any money at risk yesterday, so I did not. See what today brings. How the market settles. Now, I was expecting a little bit more fireworks because 47, he didn't do what 47 wanted him to do. He kept him, he did nothing. So, curious. But regardless of what is going on, we still have lines. The market has memory. And there will always be a higher probability of one thing happening over the other. That being that case, 697.8 is the line in the sand. 697.8 is the new high. 698.7 is the new high. Jared Sage is in the building. Shout out to you, brother Jared. Glad you could join us this morning. 698.7 is the new high. Knocking on that 700 door. Knock, knock, knock. It's amazing. Remember trading this in the 500s. Not surprised, a lot more to come. This is only January. It's going to be a heck of a year, one way or the other. All we have to do is continue to implement our discipline, and that's going to get us everywhere we need to go. Take a little bit of time right now putting this chart together, seeing what I like, seeing the areas. If anybody has any plans they've already decided upon and would like to share them, please feel free. Put them in the chat. Shout out to you, those of you who are joining us on Kick. We do appreciate you. And thank you. Me is pretty simple, but not easy. To me, the big money is below, the drop is below the 694, no doubt about it. To me, that's what a safe money is. I'm gonna put an alarm below that 694.3 area. It just is what it is. Only because today is Friday and you have a lot of things going on. I mean, today is Thursday. You have today, Thursday, being the 29th. Tomorrow is the 30th. So what we're looking at is the end of the week, the end of the first month. And with that being said, I'm not looking to get in a position, in a call rather, at new highs. I don't have a problem buying high, selling higher, but not coming towards the end of the week, towards the end of the first month. And not only that, let me show you something on the daily chart too. This blue line you see going across here, streaking across here. I need to back that up. Show the team this much larger algo here. See that? Let me make it visible for you. Give me 1 second. More visible. Okay, I can deal with that. All right, this is America. We may stumble, but we don't fall. And even when we stumble, it just presents another opportunity to get back in the market. This is that controlled buying algo that we are in right now. I did not already draw this. This algo has already been drawn. I just haven't shown it. I wanted to back up so you can see it. I have shown it a couple times though. And what we have just done now with that 697, we're at the top of it. Man, just a beautiful, beautiful call. Beautiful opportunity. 697.8 new high. So it would not be unhealthy to get a pullback all the way to the 677. That would be very healthy to help continue to make new highs. A lot of people want to be able, a lot of people are thinking now getting in at the 700 like everybody got in at the 600. Some people just love using half and whole rounding off dollar amounts. So you have investors, young investors who are looking to get in. At the 600 and ride it to the 800. Makes all the sense in the world because the people who did that at the 600 rode it to the 7. The thing is the market ready for that? That's the key. That's what we're looking for. But we do know and understand that we just hit the top of the algo. So whenever we hit the top of an algo, if we come down from that, for example, we hit the top of the algo here, back at 1027, then we pursued to come down. Got close to the top of the algo here, came down. Close to the top of the algo here, came down. Close to the top. Every time we've hit the top of the algo, we have come down. Now, recently, we came down just a little bit further than before. Now, is that possible, probable here? Who knows? But what I am looking at is even after all of this bearish fuel, the market went right up, put in a new high. Going to be very interesting what happens today if we can't break that 700, break out of this. If a breakout would be fabulous. Not calling anything, not predicting anything, because no one knows what will happen. But all we can do is read what the market is showing us. The market is at the top of an algo. Like it who like it. Don't like it who don't like it. But it is what it is. Just want to show that to the team real quick. All right. However, this is, as you can see, a very bullish week. This is a very bullish week we are experiencing. Is it bullish enough to break through? Now, this is a different version of the exact same chart. That was a weekly version. This is here is a daily version where you can see us hit the top of the algo, come down, get close to it, come down, get close to it, come down. It's just a natural recession every time we hit the top of it. So, but nonetheless, every time we've come down, if you see this, we've continued to put in what? Higher lows. We've put in higher lows. Keep that in mind, which is why I said that 677.5 is going to be a very interesting area. And if the market does pull back to that area, don't be surprised. However, if the market does pull back to that area, don't start calling for a reversal either. Nonetheless, just wanted to make you aware of the much larger picture. The much larger picture, so that you can really see what's going on in the larger scale. So keep that in mind. We're in a controlled buying algo. So any puts, they're short-term arrangements. Any puts, they're short-term arrangements. However, in order to go up, the market does need some fuel. And bears covering could be the fuel the market needs to go up. But in order to do that, you have to set some traps. Other than that, you just need new money to come on in and say, I'm willing to go ahead and buy here in this area. Will that happen as we go towards the end of the week, at the end of the month, the first month of the year? That's all. It'll be very interesting. So let's see what happens. If anybody else would like to share what they see, or if they see something just a little bit different, let me know. Feel free to put it in the chat, or if you want to talk about it, we do have a number now that the team can call in on. Let me get that phone in 10 minutes. Jesse Swanson's in the building. MYM is in the building. Nkosi's in the building. What you looking at? Breaking retest above previous day high, Nkosi says. Alrighty. That's that 697. 8. Okay. Looking for puts below 695.5. Down to 694. Nkosi, I don't even like it until it gets to 694. But in order to come down there, you got to drop $2. So, but I don't trust it. Why? I'm looking at the larger time frame. Looking at the larger frame. Okay? Looking here, even at the daily chart. Let's pull that up and talk about that one more time. With the regular size candles. Boom, if you know your candlesticks, yesterday was a doji, okay, but slightly more hangmanish. As the bulls, okay, in the end, were a little bit more dominant in their rejecting of the lower prices of 693.9 and buying back in, so much so they even gapped up today. Okay? So, in order to take a serious put, you have to realize where your money gonna come from. And in a put situation like this, your money can only come from last minute bulls who have gotten themselves in a situation where they need to cover. So it begins by them taking profit. Then it begins by them taking less profit, covering, and then stopping out. I'm looking for them to stop out. And Nkosi is looking for them to start taking some profit. And that's going to be around that 695.5, he says. I like it. I like it better below the 695.1 myself. I got a line here. This blue line here. I don't know why. I'll find out here in a minute. But I like that. So let me go ahead and put that up. And Nkosi said 695.5. All right, I'm going to go ahead and put a line there right now, sir. Put an alarm so we are alerted when we get to this area. And thank you, Nkosi, for that. Alrighty. Different area, same understanding. And that understanding is the last minute bulls would have to start covering in order for this put to work. It's just that simple. That is the psychology and the sentiment of the candles. The market is dipping very hard coming out the door. And again, this is just looking at the daily, but you still need to see the bullish strength. You still need to see the bullish strength so you don't commit to getting in early and yeah, they get ya. You don't want them to get ya. Now, let's go ahead and look. There is that area that Nkosi likes. So we're probably going to get a little bit of pullback, and that's where you want to get in. If you like this area, you want to get in on that pullback. That's going to give you a better price. Okay? It's going to give you a better price. And then as the market continues to go forward, you're now in a better position. So keep in mind, first 5 minutes are very volatile. The first 15 minutes have the ability to trick you. have you thinking the market's going one way and then completely go in a different direction. Myself, I like to wait, give the market some time, let it reveal to me what it wants to do, and then that is continuing in that effort. Not just looking for confirmation. I'm also looking for continuation. By doing that, I have to wait. So typically, I don't even take trades. I did yesterday. I mean, I will pull that trigger down here, when I have to. You know it. But typically, I like to let the market set up. But I don't see a setup this morning, let me say that would warrant me taking an early trade. Rather, I see the market moving. I understand why it's moving. I appreciate the fact that it's moving. I'm going to continue to be patient. Always, as I say before, trade based upon your own level of understanding. And thank you for sharing. Beautiful trade called out by Nkosi. For those of you who are not gun shy, Nkosi got you going to the bank. Beautiful work, teammate. Beautiful work. What? Oh no. That's okay. That's okay. It'll come back. But see, here's the thing, Nkosi, with that. You're still correct on the area. We have no control over the market behavior, but you're still correct on the area. So much so, being correct, the market is going to give you an opportunity to be shown that as it pulls back to your area, giving you that possible opportunity to re-entry if that is what you want to do. As for myself, remaining just a little bit more patient. Looking at the 15-minute chart here. Let's pull that up now. What the heck did I just do? So what did you decide to do, teammate? Did you decide to jump back in it, give it another try? Roger that, 10-4. Right down to my alarm. Right down to that area of interest that I have. Being patient at that area, waiting to see. Still very early. 2 more minutes for that 9:45 candle. This could be your confirmation. The following candle could be your continuation. It's worth it. As we explained on the daily chart and I highlighted right here, your money in this put will come from these bulls covering. It starts off with them taking less profit, and then them stopping out, and then them covering, and that is what we are seeing now. This is the area that I liked. It is absolutely worth waiting for that 9:45 candle for your continuation. We don't chase, we get in place. Beautiful move all the way down to this area. As in Kosi called out a great area. I've called out a great area. But keep in mind, as we said, any puts that you take, they are short-term relationships. You put some money in your pocket, you leave a runner. Clear place, clear distinction, 9:45 candle. This is the one that we want to see. This is the one that we want to see. You know what to do. Get your money while you can. Get your money while you can. Put some money in your pocket right now if you're in this put. Call yourself the gingerbread man. Get some of this money right now if you can. Still looking good. But we deal with areas, we deal with probabilities. So there is a very high probability in this area enough for you to put a little bit of money in your pocket. As we said, first 5 minutes very volatile. The first 15 minutes can trick you. Have you thinking the market is going one way and then go in another direction. If you got a runner on, you're doing the right thing. As the bears continue to Punish, punish, punish the bulls. Right to that 692.3. Beautiful area right to the line. You can't ask for no more. You can't ask for no more than that. Beautiful play, beautiful trade. From the 694 to the 692.3. What about if you caught it when Cozy called it? Oh, man. For those of you, Big Ben is in the building. Good morning, ladies and gentlemen. I got out too early. No problem. Oh, Ben. I guess you didn't see the line on the chart. Yes, sir. It's like a finish line. You got to hold that money to the finish line. But you know, you better get out at the finish line also. We respect all lines and know that the market has the ability to step back in and do what the market does. Which is why we say, take the money. When it presents itself to you, don't play around. Don't play with it, don't play with it, don't play with it. Take this money and get out the way with it. Yes, sir. Big Ben. Big Ben to the bank. Yes, sir. In the words of Varnell Hill, did you miss me? Yes, sir. Cozy's at the bank. Ben's at the bank. Yes, sir. Don't forget to hit the super chat. Yes, sir, man. That's what you do, man. That's the way you do it. Beautiful, 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 beautiful. Any way you want to look at it and slice it. For those of you who wanted to get in early, there was an early position at the 935 chart. As the first 5-minute chart showed us a beautiful hammer, red hammer with confirmation of price trading below the hammer institutes a great area to get in for a put. You could have taken it to the 695. You could have taken it to the 694. You could have held all the way on to it for those of you who got in late. And Cozy called out a great spot earlier at the 694.5. Oh, he called out the 695.5. He called out the 695.5 and said we could take that all the way down to the 694. And it did exactly that. I myself didn't like it to the 694, but I liked it from the 694 all the way to the 692.3. And that worked as well. Not only that, it's not even 10 o'clock. Big Ben's at the bank. The team is at the bank. And if you have a runner on, oh my goodness. It's early. Why not? I told you I love it below that 694. I explained it why. These bulls that I've highlighted here have to cover. They got to cover. And on a measured move, that brings us right to where we came, the 692.3 area. It's still early. But recognize that now you're coming into another area of support. You're coming into another area of support. But also remember, as I stated earlier when I showed you guys the bigger chart, I said if we get a pullback from this area, don't be surprised. if we pull back all the way to the 677 eventually. Why? Because we've reached the top of the algo. And repeatedly, whenever we reach the top of the algo, we always have pulled back. For those of you who missed that, I explained that this morning as I explained this chart. In the higher time frame, explaining the possibility of this pullback because of us hitting the top of the algo. And how in the past, every time we've hit the top of the algo, we've come back. We've got close to it, we've come all the way back. Close to it, come back. It's just what it is. But I've also mentioned in that same speech that each pullback has established a much higher low, which is still constituting bullish sentiment. So even with a healthy pullback, don't get too excited. It's a healthy pullback, not a reversal. Get your money while you can, though. Get your money while you can. Just wanted to explain that one more time for the people in the back. The big area is 691. 691. We get below 691. Yeah, it's a situation. Job well done. We have no idea what is going to happen here. Even in this area, you need to close. Okay, you need to close below the 692.2, and then the next candle has to be a continuation. So you have to go to the higher time frame. You look at the 5 minute, you trade up the 5 minute, you'll get burned right now off the 5 minute chart. You have to look now to the higher time frame. You have to look and see, is this going to be a continuation on the 30 minute time frame? What is it going to do on the 30 minute time frame? On the 30 minute time frame, you need to close below the 692 and then a continuation candle. That's where your safe money is. Okay? You run into a whole new set of problems with these next round of bulls. You really don't want to be involved with just yet. You might want a good healthy pullback and get in at a higher low rather than chase this if it breaks. And even with all this action, those of you who got out of the 692.3 area with me, you made more money then on your options 10 minutes earlier. Without all of this. "10 minutes earlier, the option price was better than it is now." I'm still right about the direction, but this is part of, like I told you from the very beginning, when you're in a put, you cannot marry it. It's a short-term arrangement. Because the larger scale is showing you that we are still in a controlled buying algo. But that doesn't mean there won't be opportunities to make money to the downside. Just don't get comfortable, get up and go walk away. If you're in a put, you better stay at the screen. Because he said, My original order was set for January the 30th, not a 0 GTE. I think that is why it blew by my order. Okay, I got you. Yes, sir. Jared gives a big shout out to the team. Thank you, Jared. Yes, sir. Look forward to when you in this put with us, Jared. And it won't be long. God willing. I am working hard, buddy. In fact, I'll be calling you soon here. We got our time. We got our dates for the class. I will be announcing it very shortly. We got another weather storm coming this weekend. The last one they said was coming. It came 12 hours later. It was all gone. You couldn't even tell it was here. Maybe this one might be the one to get everybody nestled up inside, slow us down for a little bit, allow me to get caught up on some necessary work. Here we go, 10 o'clock. 10 o'clock. This could get ugly. This could get ugly. For those of you who are familiar with sweeps, 691 is a market sweep area. 691 is a sweep area. If bulls are going to make any move, have any chance, they're going to have to do it at the 691. After that, it's over here. It's out of here. I'm talking about out of here. Bulls just lost control of the week. I told you about them calls right? On a Thursday, going into that Friday. Tell you about them calls, buddy. No, sir. No plans for calls today. No, sir. Plans wasn't big enough for the put. Wow. Googity Bob. Remember what I told you about that 691 though? It's a sweet area. So please don't chase. Enjoy these profits if you're already in them. My goodness. Let me show this algo. As if you really need it. Okay. Beautiful continuation. $2 drop just on that continuation alone. Waiting for the 30-minute candle. Gave you a beautiful, safe $2, 230 and more as it continue to go. Drop. Waiting on that safe 30-minute continuation candle. Beautiful, beautiful. Shout out to those of you who are continuing to punish this. It'll be an early day today. What do you think we're gonna do? Stay on here so y'all to get the money back? Huh? Who wants to get their money back? Raise your hand. If you want to get your money back, you got to go to a different channel. You have to go. You got to go tune in to the Wall Street Trapper or something. You want to go get trapped? If you try to go to the bank, I'm trying to tell you right now, it's about that time. Wrap it on up. Close it on up. This 691 is a sweep area if you know about sweeps. If you know about sweeps. If you don't, remember I told you. Let's go ahead and look at yesterday's this one up with some dirty work. Go ahead and take out pre-market so you can see just a little clearer. This big line I have right here. Woo! Yes, sir, 691. Get underneath that, you can reduce some real damage. There is a lot of strength down here. I just wanted to make you aware. I say all that to say chasing is not the answer. Wait for a pullback to a lower high. Chasing is not the answer down here. Hey, Kosi, come on, man. Yes, sir. Woo! Man, you gotta love it, man. You got to love it. And Kosi said, I am out of here. This trading is dangerous, messing with my mind, telling me I'm not going to work. I'm going, though. Yes, sir. Shout out to you and Kosi. Shout out to you, man. And salute to you, sir. Salute to you for that discipline of still continuing to go to work until it just don't make no damn sense to be there no more. Until then, let's keep going. Let's put money aside for leaps. Let's put money aside for emergency funds. Let's put money aside for dividend investments. Let's get some real change in every sense of the word. This money here, once you got it set, you can let it. It's going to take care of itself. Until then, let's continue to do what we need to do to continue to put ourselves, our family, and those things that are near and dear to our hearts in much better continuation, in much better situations. So there's nothing wrong. And I salute you for having a job and for getting up, going to that job until one day where it just don't make no damn sense to go no more. Oh man, I got my cuppa in the freezer. Oh, googity bob. I forgot my cuppa in the freezer. Yes, sir. It is chilly, chill. Man, this thing is going bananas. Anybody leave a runner? Where's Brooks? Where's Brooks? My goodness. Anybody leave a runner? Please remember, guys, I asked you not to chase down here. Not to chase. This is not the area to chase. As you will soon see. Rather, if you want to join this party, wait for a lower high to be set and established before you get in. Remember, I told you, this is a sweep area for those of you who know about sweeps. This is a sweep area. For those of you who don't, you're about to learn. This is pressure. Look on the camera. See what that is. I hear noise out there. Oh, it's the house cleaners. Okay. All right, guys, I'm going to take me a little break, sip on a little cup, huh? Oh, this could get sticky. The whole market going red. This could get sticky. That's why I pulled up the news. Because this could get sticky. Alrighty. You gotta love those girls. You know what I mean? Yeah, man. We gotta do what we gotta do to protect them, man. I sure hope ICE don't get them. I know you're itching. I know you're itching. I know you're itching. Let it get back over to 691. The 691 is the sweep area. Other than that, remember what I said. Look for that lower high to possibly get back in a short. Look at the larger time frame. Look at the larger time frame, please. The sweep area is the 691. That would be the best area for you to get in your call aggressively. Other than that, remember I said look for that bounce to possibly get in at a lower high to take a short. The sweep is the 691. You want to get above it before you commit to a call. The sweep area is the 691. Very thick teal line I have on the screen. Very thick. Other than that, remember I said you want to look for that bounce to possibly short a lower high. I said don't chase. Wait for the bounce to short the lower high. Don't go off of that 5-minute chart. It will hurt you. Look at the larger time frame right now. 3 minutes. You have that 10:30 candle. You have a new 15 and a new 30-minute candle. Remember, the 691 is a sweep area. Above it is a safe call. Below it is your lower high to get back in a put. Reporting live. This is Abdul Shabazz with What the Heck is Going On News. Microsoft is tanking, and as a result, the stock market is sinking. Googity Bob, as we come on to 686. Below the 686, you will see not me, but this person here, has a white line on the chart. If, and I say that in all node to Bob Proctor, if the market comes below 686, Googity Bob. I remember 677 being called out earlier. That might be possible today. Today is only Thursday. Had no idea this was possible or that this could take place. But I felt that I needed to come to you reporting live with What the Heck is Going On News. Microsoft is tanking. The stocks are sinking. Everybody's red. Everybody's red. Tesla's red. Apple's red. Netflix is red. Nvidia's red. Meta somehow continues to hang on by the hair of their chinny chin chin. Somehow Mark Zuckerberg finds a way to do it every time. No idea that these type of profits were available today. No one could have predicted them. If you somehow got some of this money, well, you're just lucky. Abdul Shabazz reporting live for What the Heck is Going On Now News. Back to you.
Broadly speaking, be able to meet these goals of becoming a major manufacturer of robots that can do any number of different tasks?
Look, I think what they've done with the Optimus robots is impressive. And they've got plans to produce the Gen 3 by the end of this year, sell a lot at scale at 2027. And it's hard to bet against Tesla, but there's huge competition from well-funded companies. We track a lot of these at our firm, like Figure AI, heavy backing with NVIDIA. They're very serious. Boston Dynamics, Unitree with strong support from China and subsidized product. So this isn't going to be easy. But I think Elon's going to show the world he may still have the Midas touch with that IPO at SpaceX. But this one's going to be a tall order. We'll see if he can do it.
Steve, the stock has underperformed the S&P not just over 1 year, but over 5 years. Some blame that on his foray into politics. There's been some Yale studies recently trying to count the number of cars potentially that it cost the company in deliveries. You think people will want to buy a Musk robot too?
Well, look, most of the corporate executives in the United States largely stay out of politics. That's probably a smart thing. Focus pays off well. They've really got to kick this full self-driving thing into gear. You know, they only have approval in 2 cities now. Waymo is in 6 cities, going to 12, as many as 20 by the end of the year, including New York, London, Tokyo. So focus would be a good thing. They've got a ways to go to catch up on full self-driving. They've got to prove their mettle in Optimus robots. That this is not going to be easy, but a lot of what he's done is not easy. He's managed to prove the naysayers wrong. 2026 is going to be an interesting year.
You mentioned the SpaceX listing. Do you expect that at all, in changes at SpaceX, to impact Tesla from whether they use the robots to whether, I don't know, they have to merge for the public listing, that sort of thing? Do you think that there's any room for scrutiny here around what it might mean for Tesla?
Well, there's always room for scrutiny, but I don't see a merger between SpaceX and Tesla. The good news is that SpaceX is going to have an enormous IPO this year. It's quite possible their market cap is larger than Tesla's by the end of the year. But SpaceX has done everything right. They've shown consistent year-over-year growth, increasing profitability, all the things you hope Tesla can get back to. Gwynne Shotwell, the CEO there, has really been a star, I think, invaluable to Elon. I expect her to continue to manage day-to-day operations, but I'd be surprised to see a merger on that one.
Yeah, no. I mean, more likely, what's going on with XAI. They put another $2 billion into that, right? So that certainly there is more of a connection there between Tesla and XAI.
Yeah, no, that makes sense. Probably a smart thing.
Yeah. Steve, always appreciate it. Thank you.
You bet. Thanks so much.
After the break, fresh read on the consumer from earnings spanning travel, gaming, and goods. We're going to look at some of the big movers next. Speaking of earnings, do not miss the CEO of Lazard and Raymond James, both with us next hour to break down new numbers out of both companies. Don't go anywhere.
Dividends seem to be having their moment in the spotlight again, but they're not all the same. If you're focused on income, how do you put together a portfolio that will work for you? We're going to hear from one money manager who will tell you what to look for and what to avoid. Tune into our Market Navigator segment later on today on Power Lunch, 2 p.m. Eastern Time.
Welcome back to Squawk on the Street. Here are three earnings movers we're watching. Royal Caribbean shares gaining, top of the market. Strong guidance, bullish commentary with the company saying guest spending, quote, continues to exceed prior years, driven by greater participation at higher prices. You can catch their CEO with Jim Cramer tonight on Mad Money. Meantime, Las Vegas Sands Macau results disappointing investors, sending shares lower despite an overall earnings beat. On the call, executives saying they've seen a decline in spend by lower income consumers. Stock getting punished 14%. And then Whirlpool shares are also slumping after an unexpected quarterly sales decline driven by weakness in North America. The company also announcing a $200 million charge to help mitigate the impact of tariffs. Boy, when you're an earnings winner, you really win. And when you miss these days, pretty hard, down 8% here on Whirlpool.
Meantime, an early sell-off here accelerating this hour as the Nasdaq's now down 2.25%. Huge reversals in gold, for instance, today. CFRA Sam Stovall is going to join us in a moment to discuss. Welcome back to Squawk on the Street. Stocks under some pressure this morning, dragged lower by tech. NASDAQ dragged down by more than 2% as Microsoft and a number of software names are lower. Let's bring in Sam Stovall today, CFRA Chief Investment Strategist. Talk about, one, Sam, all of these wild swings, and two, whether or not there's a 30,000-foot view that maybe we're missing.
Hey, Carl, good to talk to you again. Well, I think what's been going on is that the earnings have been coming in pretty strong. Right now, expectations are for Q4 25 to post a 9.6% rise. That's versus the 7% that was expected at the end of the quarter. We've also seen 7 sectors with upward revisions to this quarter earnings, but also we're looking for 9 of these sectors having upward revisions to 2027 estimates. So it's not that analysts are giving up on the companies. It's, I think, that because stocks are priced to perfection, that they want to receive perfection from the companies that are reporting, like with Microsoft missing in terms of cloud, with other companies. If they don't really beat the whisper numbers, then people take some profits.
Right. In the battle, Sam, between large and small cap, the Russell had been outperforming for a few weeks, and then this week, until yesterday, was pacing for its worst underperformance since November. Who do you think's winning that battle overall?
Well, the small caps are most attractive, in my opinion, based on a 20-year relative PE ratio. They're trading at a 30% discount to the S&P 500, but in a sense, it's almost like pulling petals from a daisy. Small caps will outperform, small caps won't outperform. Really sort of as it relates to the Fed, with Q3 GDP being up 4.4%, with the Atlanta Fed's GDP now at 5.4%, with inflation remaining fairly sticky, and expectations that the Fed won't cut rates until June at the earliest. I think that investors are saying, let me take some short-term profits in small caps and focus on where the earnings growth happens to be right now.
What's interesting is gold is reversed lower here, too, during the session. It's down 2%, and the dollar's gone higher, and all these correlations are a little bit thrown off. The march higher in gold, what does it signal to you? And is there anything to take away from it for equities?
Sure, Sarah. Well, I think that the reason we're seeing a bit of a decline is just take a look at the chart, and the price went parabolic, and nothing maintains that kind of trajectory. So I think investors are just taking some near-term profits at this point. Certainly because of trade tensions, I think central banks around the globe are focusing more on the precious metal as a store of value. The decline in the value of the U.S. dollar, because gold is priced in dollars, had offered a lot of support for the precious metal, and also just the momentum itself. Nobody wants to be left behind, so FOMO does affect precious metals as much as it does stocks.
As for energy, Sam, oil at one point today was up 15% for the month. I think every component of S&P Energy is above the 200-day equal weight, kind of breaking out of a multi-year range. That we got swirling headlines on Iran. Is there an easy read on this one right now?
Easy? No. The read is that there is a premium, in my opinion, being built into oil prices because of the increasing tension possibility with Iran. And so as a result of that, I don't really think anybody wants to be shorting oil at this point. Our belief is that we do have some buy recommendations in that category, but we have a market weight on energy at this point because we do believe it could turn either way at a moment's notice.
Yeah, very much. Yeah, some swan somewhere in there on either direction, Sam. We'll keep it brief. Appreciate it as always. Good to see you, Sam
Thanks.
Stovall.
Good to see you.
Coming up in the next hour. Sorry, David.
Yeah, Carl, before we head to break, I mean, it is worth noting, of course, the significant decline in software stocks right now. Obviously, we've talked about ServiceNow. Take a look at Salesforce. They're on pace for its lowest close since November of 2023. And that hasn't reported earnings. And of course, Microsoft down as much as 12%. Interesting trade perhaps going on here. Market cap is moving away from so many of these software as a service companies. And where is it going? Well, you could make an argument. It's going into private companies called OpenAI and Anthropic. I mean, which support potentially after OpenAI does this fundraise could be an $830 billion value. Anthropic somewhere around $350 billion. But man, they are really erasing a lot of market cap in these names, and that's having the impact on the Nasdaq.
And that's for CRM. That's on top of being the second worst Dow name over 12 months. Only UNH has had a bigger 12-month loss.
I mean, right now it's almost 500 points between Microsoft and Salesforce. And you know, you talk to some of these CEOs, Mark Benioff, who I caught up with in Davos, and Bill McDermott of ServiceNow, who is also there. And it's like, I don't know, Bill McDermott just showed what? 20% growth and guided for 20% growth, and and people are wondering about declining organic revenue growth, and they're kind of scratching their heads, like what are we missing? Why is the market punishing us? We've never been doing better.
About the terminal value and disruption, which we heard John Gray talking about. Obviously, semis is a great trade. Software has been nothing short of terrible.
Coming up in the next hour, CEO of Lazard's with us and the CEO of Ray J as we break down some new numbers from those companies as Money Movers begins in a minute.
Good Thursday morning. Welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla live from Post 9 of the New York Stock Exchange. Today, software stocks entering a bear market on AI disruption fears, dragging the Nasdaq down more than 2%. Meantime, Meta getting the green light from Wall Street to continue its AI-fueled spending spree, and Tesla stepping up its AI and robotics ambitions. We'll dig into the state of the AI trade.
Plus, why OpenAI might be poised for a comeback, but Microsoft might not actually reap the benefits.
And Lazard CEO Peter Orszag with us, why he thinks that deal-making is set to ramp this year, despite lingering policy and geopolitical uncertainty. First up, though, in the markets, it's getting uglier. We've seen this decline pretty much throughout the morning. There are still some pockets of strength, like energy, which is working really well, financials, utilities, some of the cyclical groups higher, but it is the tech trade. Information technology in the S&P as a sector down 4% right now. So that's really what's weighing on things. That's why the Nasdaq is down 2.5%. Microsoft getting hit the hardest. Nvidia, though, Tesla, Amazon, Palantir, they're all sort of weaker in sympathy.
Let's begin with this move in technology and sustained weakness in software. Names like ServiceNow, Salesforce, Intuit, all down very big. Our Seema Modi has more on what might be driving today's action. Hey, Seema.
Hey, Carl, let's start with ServiceNow. If we look at the street reaction this morning, a few analyst price target cuts, but I would point out most analysts are keeping their buy overweight rating on the stock, including JP Morgan, Deutsche Bank, and UBS. Now, on the call last night, CEO Bill McDermott made the case to investors that it's taking the necessary steps, from acquisitions to launching AI agents that they say will ensure ServiceNow remains not just relevant, but a key player across the AI landscape that doesn't just set the company up for short-term wins, but long-term wins. But again, that messaging still not resonating with investors. The stock down another 12% as software as a whole fights this very tough narrative and souring sentiment following what Microsoft said as well last night. The tech team at BTIG writes this morning that this is what they say for ServiceNow, a phenomenal buying opportunity, adding that there is continued disconnect between software valuations and the fundamental story. I would also point our attention to shares of SAP plunging following earnings that disappointed. Its cloud backlog missed, which, as Wedbush points out, is not only helping but also amplifying these AI competitive fears. What this all could lead to, guys, is once again an opportunity for M&A. I wrote about this online last week, but I spoke to a large investor at a private equity firm who says that we're going to start to see more deal making, take privates, and an opportunity for the larger software companies to become more acquisitive. Sarah, I know you spoke to CEO Arvind Krishna. I separately spoke to the CFO of IBM, who said that that clearly is a strategy they're going to continue to use, becoming more acquisitive.
Yeah, no, and they've been doing some big deals. They just did Confluent, but it is something that I heard from the investor Orlando Bravo in Davos like a week ago or so. He said we're going to see a lot more consolidation in software, and he said he was licking his chops because he likes to take some of these companies that are undervalued actually private. What is the concern? Because ServiceNow would point to very strong double-digit growth and guidance on results.
Right.
So what is the nagging issue here that investors seem to have?
One of the big issues is just the unknown as to how the popularity around Claude and other models like that will gain popularity and also be able to win enterprise customers. We also know OpenAI, if this fundraising round is expected to go better than expected, what we're hearing is that actually tells the market that they will have a larger budget to use towards creating applications that, again, targets that corporate customer that all these software companies we're showing right now on the screen rely on. We don't have that level of clarity right now, and that's why I think we're seeing this type of price dislocation. Plus, these earnings, yes, good, but I think investors were hoping for a bit better than expected, given the type of tape they were fighting going into this report.
Okay, Seema, thank you. Down 11% on ServiceNow. Mike Santoli here to break down this market action. Yes, the software, Mike, but some of the big AI winners, too, are getting dragged in.
For sure. It's kind of the destruction part of creative destruction that's in focus. Microsoft clearly the biggest downside driver, but it is interesting how there's also this failure of the market to rotate away from it. That's been a strength of the market in the first few weeks of this year, and you're seeing just not enough on the other side of the spectrum when you have IBM. But the other piece of it is so many parts of the asset markets were wound so tight with some of these momentum moves like gold and silver, like the memory chip stocks, and they're also cracking. That's the difference this morning, is that the little bit of a volatility eruption, you got the VIX above 19, has a lot of those kind of momentum stampedes having a rethink. I think that's significant here in terms of just the cross-asset implications. You have oil up. I don't know that it's necessarily people having any kind of a panic about the macro picture. It's much more about positioning. Yesterday, we got a widely followed weekly sentiment gauge that was really in thin air. That's the Investors Intelligence, bulls versus bear. So that's just a background condition that says the market was kind of getting lucky with this rotational move. Now, it's not a washout today. You actually have like 40% of stocks on the New York Stock Exchange are higher. It's just not quite enough. And I would watch the unwinds if we get them in gold and silver, just as an indication of where the fast money is forced to retreat to.
Yeah, we saw gold turn around. It's now weaker.
Yeah.
Dollar went stronger. I mean, a lot of sort of interesting cross currents. Bitcoin is getting slammed.
Yeah, Bitcoin is, it basically has a massively high burden of proof. It has not done its job in any respect, and it's basically been kind of a risk asset. And what's been driving the gold and silver move is obviously everyone kind of wants to talk about the dollar debasement story, whatever it might be, or just a diversification story. It's the preferred diversifier. People don't like government bonds, even though they've been fine. Treasuries have actually been tame. They don't like government bonds in asset allocation as much as they used to. They want to diversify away, and Bitcoin proved much more of a risk proxy than a diversifier. There's also no perceived scarcity. I keep saying this. The unifying factor in the memory chip surge and gold and silver is a story of acute physical scarcity, especially in silver, and that means forced buying. Or I'm saying this is a story. It's not necessarily a reality.
Well, we had a discussion with Jim this morning about what hedging is today, right? When the dollar doesn't rise on uncertainty or on a good economy, when treasuries sort of lose a risk-free reputation, when private equity valuations are in decline, or I mean, where else do you turn?
Well, that's right. I mean, I do think a lot of investors globally are having that kind of a conversation, and gold coming off a low base in portfolios can kind of be the net gain there. On the other hand, treasuries have done their job, okay? The 60-40 portfolio had a great year last year. So it's much more about kind of perception that because we have the fiscal taps wide open globally, we're just going to keep getting more and more government paper. So there's honestly no reason to rush to buy it today, and you're going to be forced to take it. And so the clearing yield might be higher than you would prefer. But I don't think it means that bonds can't diversify. Because I have to say, if we get a recession, if we get a major growth scare, treasuries will be bid ultimately.
U.S. treasuries.
Yeah, exactly. Yeah. I mean,
that'll be the debate.
Yeah.
Who's treasuries?
We're in trouble. Right.
I mean, it's a good sign, though, that you said not everything in washout. Financials are up, utilities are up, communication services up. Comcast, some of the media names doing really well today. Staples,
the market's going to try.
And energy.
It's going to try to rotate around. I just do think, though, you also have just lack of momentum in this move. We keep, kind of trying for that 7,000 level. You got there intraday. We've been in this, unable to get escape velocity for over 3 months now versus those late October highs.
All right, we're less than 2% off the highs for the S&P. 3% off the Nasdaq. Yeah, just to put it.
We've just been kind of stuck for 3 months.
We had a record high this week.
Yeah,
exactly.
Yeah. Yesterday, I think.
Yes. Meantime, Meta is bucking the trend, as Sarah said. Stock's having its best day since July after this big earnings beat and pretty good guidance. Our Julia Borston has more. Morning, Julia.
Good morning to you, Carl. That's right. Meta shares up about 7% as investors shrug off concerns about growing CapEx, as Mark Zuckerberg explained how the investment is and will continue to pay off with the likes of new features like agentic shopping.
There's going to be, many, I think, new business opportunities that come up. I mean, we have been working on Meta AI for a while. I think you're starting to see some of the way that products like that get monetized across the industry. When we get that to a scale and depth that we want, we think that there are going to be opportunities both in terms of subscriptions and advertising.
Zuckerberg outlined how AI is already driving results. Paid messaging on WhatsApp now has a $2 billion run rate. Threads has momentum and is expanding to more countries, they said. And they also said that the company's AI-enabled glasses have tripled sales in the past year. Wedbush's Dan Ives saying, quote, the aggressive level of investment within the current cycle is already delivering healthy revenue in upside versus expectation and signals a commitment towards longer-term strategic objectives. Now, Zuckerberg also talked quite a bit on the call about how AI is enabling employees to be far more effective, saying one engineer can do the work of a whole team, but they are paying a lot more for that engineering talent. After infrastructure costs, the second largest contributor to total expense growth is employee compensation, driven by investments in technical talent. Back over to you guys.
So do you think this changes the narrative on Meta? Because remember, it was so weak after the last quarter because I guess investors just weren't satisfied that they had enough to show for all of the spending. Does this change that?
I think this does signal a real shift. Analysts were expecting the company to guide to CapEx this year of about $110 billion. Instead, the guide was to between $115 and $135. So meaningfully a range above that consensus expectation. And I think the fact that the guidance for the first quarter revenue was so much higher than expected, and the fact that Zuckerberg laid out all of these ways they see monetization opportunities beyond even what they're doing now, I think that has calmed concerns about the CapEx increase pretty meaningfully among the analyst community and among investors. So we'll still have to see what happens. Zuckerberg said they'll be launching a number of new products this year. We don't know what they are. We don't know how consumers or advertisers will respond, but certainly more optimism now than there was after the last earnings when the stock really suffered.
Julia, thanks. Big name to watch today. That's our Julia Borston on Meta. Another earnings mover today is Tesla. Shares are down close to the lowest level since about Thanksgiving. Company did report its first annual revenue decline. Joining us this morning is Hague Partners Managing Director John Murphy. John, it's great to have you back. Thanks for joining us.
Thanks for having me.
We had a long discussion today about negative revenue, deliveries down 10, auto margin cut in half for the year. Does it even matter at this point?
Well, you know, I think there's a lot of surprises that came out of the quarter. The earnings actually were a little bit better than feared in the fourth quarter. And we saw Elon pull off one of the biggest pivots I think we've seen in any large company, maybe in history, that was kind of somewhat expected this quarter, or expected by some bulls on Tesla. But this pivot away from autos and a great recognition that the Chinese EV manufacturers are the name of the game in mass market globally, and he's not going to be able to compete against them in that side, that he has to really lean in to technology and invest heavily in that direction. And I really applaud them for canceling the S and X and really taking some really hard steps and moving in this direction quickly.
Those are tough decisions. Is the horse race a little easier on robotics than it is in cars?
Well, you know, it's unclear where the finish line is in that race. Let's start there. So, no, I think it's going to be very difficult. I think, you know, when you look at this, he's going to continue to focus on the auto business to some degree, because you need the hardware to deploy the artificial intelligence. You'll need the robots to deploy the artificial intelligence over time. But, you know, he's going to leverage that. Plus, I think the energy business, which is still growing, is a core business that's incredibly competitive, as you mentioned, and they might have some success there, but he's going to use that to fund the future, and the future is robotics and autonomous vehicles.
It does make you kind of wonder about the other automakers and their strategy, like a GM or a Ford. I mean, GM had a great quarter, but they're not doing this.
Sorry, yeah, it's a really important point, because I've been counseling these companies for the last few decades to really focus on this core to future strategy. And that's really getting away from, you know, the marginal small vehicles, some of the markets like China that they really need to get away from, and really focus on where they're profitable. For GM and Ford, that's North American trucks. For the G3, it's, you know, German 3. It's luxury. So those are the only two places that people have really ever made significant money in the auto industry. And these companies need to look at what Elon's doing and take a lesson from his playbook and really get aggressive about rationalizing the core so they can fund the future. So it puts them in a tough spot. It's a very good point.
In what parts of the economy does the TAM on robots fatten first? Because Elon talks about us all owning one, but I can't imagine that you think it's going to be a retail product first. Is it an industrial product and then retail? Where does the consumer fit on the timeline? So
should I admit robotics start getting? I'm an auto expert for the last 30 years. I think robotics, you know, on wheels is what we'll see things really take off first, and that's autonomous vehicles. Then you get into the humanoid robot, where you'll have factory applications, industrial applications, and, you know, high-end folks that are multi-billionaires that want, you know, 10 of these robots running around their house, and they can afford these. And that's probably where to start, and it will bleed down like all luxury high-end tech products do over time.
You think one day it's going to be like having a car? Like most of us will have at least one?
I think that's probably decades in the future. But personally, I think it would be great.
You're talking about the Optimus.
Yeah, the Optimus robot, yeah.
What about robo-taxis? Because that was also part of the future vision story here. And there are some expectations of when that might hit the market and how much we'll see there in terms of earnings.
So I think there's a reality of this right now in San Francisco and other cities where Waymo is actually fairly successful, and it's actually working. What that actually changes in reality is removing the driver and not much else, because the vehicle is operating in a similar fashion. I think where this really gets interesting over time, and this is kind of a wonky thing, is thinking of if you have these autonomous vehicles that can't actually hit anything, potentially we could save time by organizing traffic in city centers. I just got stuck in traffic on the way here, as well as getting higher speed travel on highways. And I think that is really where you get real productivity gains in the economy by saving time with this autonomous technology. So yes, I think that's a big part of the value creation over time. Maybe not just for Tesla, but hopefully the rest of the industry as well. And all of us.
There's some regulatory questions that are going to be answered in there, but
1956 was the last time we invested in a big way in the network of roads in the United States. I think if Trump is listening right now, this would be a signature policy of him to really change and advance the networks on the road, so we actually could do this.
Right. John, thanks. Good discussion.
Thanks for having me.
Well, he and Elon are on good terms again, so maybe.
I was hopeful originally that they could pull this off, because if you create these high. We get into a long discussion. It's happened before. It happened here in Manhattan, right? When we had the Model T and subways come in, people spread out, and population's never grown since.
All right, it's cool to think about. John Murphy, thank you.
Thank you.
All right, still to come this hour, Lazard CEO Peter Orszag just out with a big earnings beat. The stock, a winner this year, up double digits in January alone.
Neuberger Berman ups its outlook for emerging markets led by a couple key countries. We will get to that when Money Movers comes right back.
Welcome back to Money Movers. Check out shares of Lazard trading higher by more than 3% after the company reported a top and bottom line beat for Q4. Lazard also posting record full year revenue from their financial advisory business. And speaking of the financial advisory business, Lazard consulted a number of high profile M&A deals in the quarter, including Mars acquisition of Kellanova, Cognizant's acquisition of 3Cloud, both deals that we covered right here on the show. Joining us in a CNBC exclusive is Lazard CEO Peter Orszag. Welcome back, Peter. I mean, this is a big bottom line beat. Is that the main driver here, the M&A environment?
Well, I actually think we're making progress on both sides of the business, advisory. And within advisory, by the way, it's not just M&A. We've got roughly 40% of our advisory business is now non-M&A. We've been building that out. That's restructuring and liability management. It's fundraising, especially secondaries and so on. And then we've got the other part of Lazard that is also progressing on the asset management side. So that's the second full year, 2025, in which I've been CEO of Lazard. We're making really solid progress towards our Lazard 2030 objectives, and we're going to keep going.
So you're saying it's not just the overall environment and the capital markets, it's also what you guys have been doing internally.
We believe so, yes, and I think that will become increasingly apparent over time, because what's actually remarkable is we've been transforming and making investments in both of our businesses, and normally there's sort of a J-curve from that you have a temporary dip as you're making those investments. We've been growing throughout, but I think that growth will accelerate in the future.
What does M&A look like for the next few months here in the U.S. and outside the U.S., where you've been growing a lot too?
I think the conditions are very promising. We'll have to see how it actually turns out, but you've got several things going on at once. You've got the ongoing march of the benefits of scale and focus, which has been leading to a lot of M&A. You've got some areas of weakness, like in software that you were just mentioning. That's another vector for M&A. And then you've got a regulatory environment in the United States that is more accommodating. It's also more political, but it is more accommodating than it was under the prior administration. And I think CEOs and boards see a window to try to get deals done.
Yeah, I was going to ask you, you said more political. I mean, geopolitical risks have risen, certainly to start 2026. And I wonder if that's having an impact on the business and the outlook.
Look, I've increasingly referred to something called contextual alpha. You can't just do the kind of alpha part, which is the financial analysis on a spreadsheet, but you need to take into account the geopolitics, the regulatory environment. This is something that Lazard has always thrived at in terms of giving that kind of contextual alpha advice to clients. It is all the more important today because you really can't make important decisions without taking these global issues into account. An environment in which contextual alpha and also AI are dominant is an environment in which we believe Lazard's going to thrive.
What about outside the United States? I know you recently, I think, opened an office in Denmark. I don't know if you're making a play for the Greenland deal
there,
yes.
or
what. But what is the opportunity set?
Denmark. Yeah, and we also last year opened a new office in the Emirates also. Look, I'd say a lot of what's happening here is that companies across the globe are responding to this new order. And I think the most important development is we are seeing a fracturing between the China pole and the U.S. pole. Companies are trying to figure out how to navigate within that, especially and including a lot of companies in Europe and in the Middle East. And from that perspective, one of the more interesting developments at Davos was Mr. Carney's speech, not because of the word rupture, which is what got all the attention, but rather this proposal that the Trans-Pacific Partnership should join forces with the European Union. That would create a third pole. In any case, companies across the globe are trying to navigate all of these complexities. And so there's a lot of activity as people reconfigure their business mix and their geographic mix to respond to a new world order.
Okay, I'm so glad you brought up Carney's speech in Davos, because since then there's been this war of words between Carney and the Treasury Secretary over a call after Davos with the President Trump. So I spoke to Treasury Secretary Bessent yesterday, and I asked him about it because Carney said that he dug in when he talked to the president and said he stands by what he said in Davos. And the Treasury Secretary is saying something very different. Just listen to how he responded to it yesterday.
I've seen what happens when a technocrat tries to pivot and become a politician. It never really works out well. So I would just encourage Prime Minister Carney to do what he thinks is best for the Canadian people, not his own virtue signaling, because we do have a USMCA negotiation coming up. And he rose to power on an anti-American, anti-Trump message. And that's not a great place to be when you're negotiating with an economy that is multiple larger than you are and your biggest trading partner. In the end, I think we will end up in a good place. It may not be a straight line.
Peter, that's tough stuff.
Look,
What's your reaction?
I'm not going to get in between the secretary and the prime minister. I would note that the new Canadian ambassador to the United States just came from Lazard, so I will leave it up to him to navigate that. I think Mr. Carney was putting forward a perspective that obviously he believed was in the self-interest of the Canadians, but beyond that, I don't think it's constructive for me to adjudicate this dispute between the secretary and the prime minister.
Peter, stay with us. We want to get back to HQ this morning with our Leslie Picker, who's got some breaking news. Leslie?
Hey, Carl. Yeah, this is a development in the First Brand situation. You recall that was one of the cockroaches, the so-called cockroaches, filed for bankruptcy in September and created some turmoil in the credit markets as a result. Well, now we have learned that the United States District Court for the Southern District of New York, there is an indictment against the CEO, Patrick James, as well as his brother, Edward James, who was an executive at the company as well. Multiple counts, 9 counts in this filing here, but they basically are alleging that Patrick James and Edward James perpetrated a series of fraudulent schemes against the company's lenders and financing partners. First Brands, they say, faked and falsely inflated invoices for accounts receivable and payable, double and triple pledged loan collateral, falsified corporate financial statements, and concealed substantial liabilities from lenders. They said that yielded billions of dollars in financing to First Brands and allowed those 2 defendants to reap millions of dollars in proceeds as a result of their alleged fraud. We are efforting a comment from those defendants. We'll let you know when we hear back, guys.
Okay, thank you, Leslie. Leslie Picker. Peter Orszag's still with us. I think you actually advise on the bankruptcy of First Brands, Peter. I don't know if you want to get into specifics on that or not, but just in general, what this would signal to me is that there's not.
We are.
Yeah, go ahead.
No, I'll just say 2 things here. We are involved in the restructuring and liability management here, so I obviously won't comment beyond what I had said previously on this, which is our team at least believes that this is sui generis. It's not an indication of broader issues in private credit, which is the way that it had been, characterized before.
Right, and that's just what I was going to say. It's like a takeaway here is that, bad apples, cockroaches doesn't necessarily mean systemic issue. I am curious though what it all means for your restructuring business, not this necessarily, but you've been making some changes there and what the update is and the outlook is for that business into this year.
Yeah, we had a very strong year in restructuring and liability management. We have rebuilt the team so that it does both restructuring and liability management. It covers both debtors and creditors. It's a much more diversified business. I think the most important thing here is that historically, when M&A boomed, restructuring and liability management did not, and vice versa. I think that is changing, and the reason is companies are now vastly divergent in terms of their performance. So you've got firms that are at the frontier and they're booming, and then you've got firms at the 10th percentile that are struggling in the same sector. And what that means is a very strong incentive for the leaders, the frontier firms, to buy the typical firm to improve their performance. But at the very same time, firms that are at the bottom need help, especially with liability management. So we see continued activity in restructuring and liability management at a rapid pace, even while M&A comes back, or M&A continues to gain momentum.
Sure. I just want to, because we're seeing such a broad sell-off in tech right now, Microsoft's down 12.3% on earnings, and it's dragging everybody else down with it. The software stocks have been getting shellacked, even on decent numbers. What are you picking up from your corporate customers when it comes to AI adoption and just how much enthusiasm there is and how much transformation is actually happening where they can see a payoff?
Well, look, I think this is the thing to track. The U.S. economy basically does look promising, but it looks promising because of AI and high-income consumers, and the high-income consumers are spending because of the equity effects from the AI, so it's also somewhat fragile to exactly this. We see continued improvements. I think there are doubts about the rate of improvement. Jan LeCun and others pointing out the kind of flat of the curve, that we won't see continued improvements from the large language models in particular. In our experience and in my own daily life, we see continued improvement. I use these tools all the time, and we're using them throughout Lazard. And by the way, on the topic of AI, I heard your prior segment. As a consumer, I'm a massive fan of the Meta AI glasses.
Oh, you are? Really? What do you use them for?
Yeah, I use them all the time. They're amazing. I use them for phone calls, listening to podcasts. The audio is remarkable, and I'm a proselytizer on this front.
Okay. Did not know that about you, Peter. Thank you for joining us on a number of topics
There we go.
We appreciate it. Peter Orszag, CEO of Lazard.
Good to be.
Later on this hour, another name in the financial sector reporting. The CEO of Raymond James today is with us, reporting record quarterly revenue, although the street showing some concern about lower investment banking numbers.
And then, as OpenAI grows, the ecosystem of winners is changing, leaving some of its original backers in the rearview mirror. We're going to dive into that story when Money Movers returns. Welcome back to Money Movers. Stocks under pressure this morning. Weakness in software leading the NASDAQ down more than 2%, but it's more than that. We've got Microsoft down sharply, more than 10%. Here with us now at Post 9 is Neuberger Berman, Private Wealth Managing Director, Holly Newman-Croft. Welcome back. It's great to have you.
Always great to be here. Belated happy 2026.
Yeah, we haven't had you since the new year.
Yeah.
So how are you feeling about the market? We're pulling back pretty sharply today, and you see what happens when these tech names don't work. It weighs on the whole market. Is that how it's going to be?
You know, the market fluctuates so much every day, and if I had been here 2 days ago before the earnings release, I would have said to you, I'm loving 2026. We're seeing a rotation. We're seeing a move away from the tech names in the Mag 7. And then yesterday, with the earnings release for Meta and Microsoft, I think what's so interesting is that both companies beat their earnings expectations, and yet the market reacted so sharply and in a contradictory fashion to both companies. So I think what's interesting is AI euphoria isn't over. The Mag 7 is going to continue to have strong earnings growth. They are going to continue to significantly impact the S&P 500 as they have each of the last many years. But I think investors now are looking at each of the companies with a more discerning and critical eye and really listening to what their CapEx spend is intended for and do they buy the story. Whereas certainly in 24 and 25, when the Mag 7 contributed more than 50% of the returns of the S&P 500, we're seeing what we saw in 2025, which is a continuation of doing a deeper dive into each of the 7 companies and looking at them independently as opposed to a basket.
But you must be happy to see, I mean, you have been one that has been rooting for the broadening out trade, the small caps, the emerging markets, and actually all of that was working nicely. Even today, in this pretty big sell-off for the NASDAQ, you have a number of sectors higher: industrials, financials, consumer staples, real estate, and energy.
I do like that. You know I like that. I think concentrated growth in 7 companies is not sustainable and too risky for investors. And Neuberger continues to be overweight in the small cap space. We were overweight last year as well. It had its best performing year last year, but it is still woefully underperformed the S&P for 12 plus years. Small caps do well in a deregulatory environment. In this administration, which is very pro-business, interest rates are down from where they've been. And so we are very constructive on the small cap space. Valuations are so much more attractive. We do think the core equity exposure for investors is and will continue to be the U.S. large cap space. But at the beginning of the year, it is critical that clients look at their portfolio not only to rebalance in terms of risk, but take some money that might have been parked in cash and allocate it opportunistically. So we are overweight small caps. We are overweight emerging markets. Last year, we were overweight international developed. We've moved back to a neutral position and switched to emerging markets, really driven by India and Brazil. We are seeing a lot of AI-related companies that are so undervalued compared to those in the United States. And unlike last year, where we had a lot of concerns about the integrity of the countries because of the tariffs and the new administration, those concerns have largely been eased. So there's the potential for a lot of international money flowing into these emerging markets, strong economies, and terrific and attractive valuations.
I mean, Starmer's in Beijing right now. First visit for a British prime minister in 8 years. We've had deals this week with the EU and India. There's reports of South Korea, Canada. We know Canada did some China. I mean, I'm wondering if international trade ex-US is driving some of that thesis.
Yeah, I mean, it's such an interconnected world, right? And you can make the argument that the S&P is still a global investment since half the revenues come from overseas. But I think there is a real acknowledgement, not only by us and by U.S. investors, but by the rest of the world, of the opportunities in these strong countries, strong economies, with huge opportunities to benefit from AI and other industries that we just haven't focused on, because the Mag 7 has not only driven returns, but it's also driven headlines.
What about the notion that we always say, all right, so many small cap components lose money, you know, the efficiencies of AI are going to the big guys, not the small, and now this notion that we're not going to get rate cuts till June. Are those all indictments of small caps?
I don't think so. What we saw last year, and I think we talked about it in December, 90+% of the return of the small cap index was from non-earning companies. I think we're going to see an appreciation for higher quality earning small cap companies. And that goes along with the theme of you tear apart the Magnificent Seven and you look at those company by company. It's the same thing with small cap. I think that index last year benefited from the euphoria, broad-based euphoria on AI, whereas this year there will be an acknowledgement for companies that have strong balance sheets, strong income statements, they earn money, and they have a business plan that investors can understand and really believe in. Companies ultimately have to make money or they're going to, cease to exist. And I think once you get over the excitement and the euphoria, investors have an appreciation for that fact as well.
Holly, we always used to ask you what you told your high net worth customers about Bitcoin, which was not, right? You weren't going to go there. What do you tell them when they call you and say, how much gold should I have?
So we continue to maintain an exposure to commodities. It is, in general, a diversified bucket in general is a good hedge against geopolitical risks and inflation. And if the Mag 7 isn't leading the headlines, then it's certainly geopolitical everywhere, right? It's more broad-based today than it was 12 months ago. We specifically like gold. I know there's a pullback today. We like precious metals. And we think that commodities will maintain an important role in client portfolios.
How much gold? How much of your portfolio should be in gold?
100%?
That would have been helpful.
If you're not
in the last 12
taxable,
months.
it would be great. If you could market time and not pay taxable, sure, 100%. But look, we have a commodity exposure of 5%, and within that, an overweight to gold and precious metals.
Okay. Thank you, Holly. Great to see you.
Good to see
and have
you
you
as
as
well.
always. Holly Newman-Croft from Neuberger Berman.
Thank you.
When we come back, following increased competition from the likes of Google, Anthropic, and others, OpenAI is poised to try to make a comeback, but could some of the original backers be left behind? That story when we come right back. Big tech seems to be deepening its bet on OpenAI as NVIDIA, Microsoft, and Amazon may be in talks to invest in a new funding round for the company. Our Deirdre Bosa has more in today's Tech Check. Morning, Dee.
Hey, good morning, Carl. So the money lining up behind OpenAI, it tells you something. Some of the biggest players in tech, they're betting that OpenAI can take back the narrative in the next model cycle. An OpenAI comeback after Code Red, months of sliding down the technical benchmarks, rising pressure from Google's Gemini. Now, its next model, GPT-6, it's expected in the second quarter. And this is key, it's being trained on NVIDIA Blackwell chips. That matters because Blackwell is supposed to change what's possible at the very top of model training. And just like we saw Gemini 3 flip the narrative and the investment thesis, that could plausibly happen again, but this time in the OpenAI universe's favor. So you're looking at these sort of different universes right here. The OpenAI one is Oracle, AMD, Microsoft, NVIDIA, CoreWeave, SoftBank. The infrastructure that's exposed to OpenAI, it suddenly has a very different setup if GPT-6 does reset the benchmark race. For Microsoft, though, the relationship has become more complicated. It is no longer the primary financial or strategic beneficiary of OpenAI's success. Its biggest cloud rival, Amazon, may be getting a stake through this new funding round, according to that reporting. And Microsoft itself is already diversifying by giving customers more choice over which models they use and making an investment in Anthropic, by the way, OpenAI's rival. Now, you also heard some defensiveness on the earnings call last night. Amy Hood pointing out to analysts the mix of backlog as a glass half full, 55% Microsoft, 45% tied to OpenAI. Now, for big tech as a whole, though, investors are looking for execution, and Microsoft may be losing the street. An hour ago, you guys were talking to Melius's Ben Reitzes, who has rated the stock a buy, and he told you that Satya Nadella is playing catch-up to products like Anthropic's Claude Cowork, and they need to fix this narrative. So, guys, an OpenAI comeback, if this does come to fruition, will change the investment thesis in the AI race as a whole, but it won't be the same boost to Microsoft that it has been in the past.
Yeah, I was talking to Brad Gerstner about this yesterday in Washington, D.C. from Altimeter, who's one of the big backers and big investors of OpenAI. Talks to Sam Altman. He showed me a chart that showed the usage of OpenAI ChatGPT versus Gemini, and it was just sharply higher and faster. And I do wonder GPT versus Gemini, and I wonder if that's what you hear too, and how that feeds into the question. I feel like investors are very fickle with how they feel about OpenAI, but you can never quite know because it's not public.
And the metrics are fickle too, right? It depends on what you look at. Like yesterday for that scorecard we did, we were looking at tokage usage, and we were looking at the technical benchmarks. And actually, you see that OpenAI has been falling off a little bit. Just on those two measures, you're seeing a lot more momentum. And anecdotally, too, you hear about that from people who are building, developers, investors. It's all about Anthropic right now. They feel like the steadier bet. But the point is that it can all change with a new model release. I was skeptical that Gemini 3 would change the landscape as much as it did, but it really did, from the token usage numbers that I'm seeing to the adoption rates, monthly active users, to time spent on each site. So it's just extremely, extremely fluid. And maybe Gerstner is getting ahead of this, right? Because he knows that the next model is coming out. Maybe we are about to see that come back.
Yeah, okay. Thank you, Deirdre. Deirdre Bosa. On the AI race, the CEO of Raymond James coming up after the break, just reporting record quarterly revenue. Shares trying to get back into the green over the past 12 months. Stay with us.
Welcome back. Raymond James missing on both earnings and revenue estimates for the latest quarter. Investment banking revenue down 37, raising some questions. Joining us exclusively this morning is Raymond James CEO Paul Shoukry. Paul, it's great to have you. I mentioned the IB number. I think it sounds like it is a bit of a timing issue, is it not?
Hey, Carl, great to be here with you. The pipelines for investment banking are very robust. There are a lot of motivated buyers with dry capital and dry powder to spend, and a lot of motivated sellers. Most of our M&A activity is financial sponsor backed, and so our pipelines have been building. We're very optimistic about the fiscal year ahead in 2026, and really largely due to timing and deal slipping, the quarterly results were weaker for investment banking. But for the firm overall, record revenues of $3.7 billion. We finished the quarter with record client assets of $1.8 trillion, up 14% year over year, and fee-based assets were up 19% year over year.
So no reason to think that the banking business, the investment banking business, isn't set for an historic year, would you say, in 26?
Well, I would hope so, but investment banking is very difficult to project, as you know, and so the pipeline's strong. A lot of the ingredients are there. Financing is available, relatively attractive cost financing for deals to get done. I think maybe the one impediment is just there is still, in certain cases, a bid-ask gap between buyers and sellers. Sellers, especially if the buyers got into the market during the COVID period at really high multiples. They're now looking to sell some of those investments, and in some cases, those multiples have softened a little bit. So those gaps are converging, and I think there will be not only Raymond James, but really the entire industry has been speaking with a tone of bullishness around investment banking.
Is AI fundamentally changing the way that you guys work and empowering your advisors? And does it mean that you're not hiring as many advisors?
No, we're really focused on what we call the power of personal. So the personal relationship, especially in the financial planning business, is going to be absolutely critical, and that's our bet going forward. What AI is changing, and we're investing heavily in AI, is helping advisors develop even more deeply personal relationships with their clients in a more scalable and efficient way. Just this week, we launched an AI service tool called Ray, R-A-I, play on Raymond James, and it's basically a natural language agentic AI model where you can ask any question related to client accounts and get answers directly. So you don't have to call in or even search on our search database. You can get more information at your fingertips in a much quicker way to service your clients and spend more time on the personal relationships and less time on the administration. But we're still in the first inning of AI. I think the entire corporate America is still in the first inning in AI, but the opportunities ahead of us are significant.
The dollar numbers that you spend on investments like that, is that going to rise in the next year, the year after that? Any reason to think that would flatten out? Or are you talking about second derivatives of growth?
Absolutely. We're looking to spend about $1.1 billion on technology this year, which is up 8% over last year's technology investment. But if you look at within that, the investment in AI, it's up multiples of that 8%, off of a smaller base, of course. But yeah, we are going to continue to rapidly expand our AI investment to help advisors develop better relationships with their clients, but also to help the service areas develop more scale in their operations as well, so we could do more with the same number of associates.
So ultimately, how do you see it changing the business? And just your own and the entire industry?
Yeah, for example, when we say the power of personal, how can AI help an advisor develop even more personal relationships with their clients? Well, we have the next best action, which is a tool that, based on all the data that we have on the clients, advisors can very quickly prepare for a meeting based on the notes from the CRM from the prior meeting, what the follow-ups are, come up with some next best recommendations for things to look at, whether it's estate planning, tax planning, 529 investments, etc., and really have a tailored meeting enabled, much more personal, but enabled by AI and technology.
But is that higher growth for you? I mean, it's obviously more productivity for your people.
Yeah, so That's what advisors are asking us for, and even investment bankers, they're asking us for, help us use this AI to spend more time with clients and prospects so we can bring in more assets. And that's exactly what we're doing, which should not only drive higher productivity, also in the aggregate drive higher growth as well. And having a differentiated platform, I said we're investing $1.1 billion on technology a year. A lot of our competitors, the private equity-backed competitors, smaller regional competitors, can't afford to spend that. And so we're becoming a destination of choice. Just this quarter, our annualized net new assets was 8% this quarter, the highest in the industry for anyone who's reported so far. And a large part of that, most of it's the culture. They see Raymond James as a destination of choice for the culture, but the technology and the AI investments that we're making, when they come in, they're blown away by the capabilities here versus those other firms who just simply don't have the budget to invest in technology to that extent.
Sarah mentioned employment. I mean, it seems like the tone from a lot of financial services when it comes to AI and headcount is it's not going to mean layoffs per se, but we think the business can be much bigger in 5 years with a comparable set of employees. Does that seem fair?
Yeah, Carl, that's the focus right now, is to just do more with the same number of employees to make employees more efficient. We're a growth company, so if you look at our budget for the next year, we're actually looking to grow headcount again, and we've been consistently growing headcount. But what we want to do is bend that curve where we don't have to grow support count as much as we're growing revenues and advisors and bankers. And so that's what we think AI will help us do.
Paul, appreciate it very much. Fascinating quarter. Amazing where we are in this trajectory. Thanks for coming on. Paul Shoukry.
Thanks to you both, Sarah, Carl. Thank you very much.
Tomorrow on the show, can't miss interview with Fed Governor Stephen Miron, who dissented at the Fed meeting, as he has done every meeting that he's been a part of, and questions about whether this was his last Fed meeting with his term expiring Jan 31st, but Secretary Bessent leaving the door open to potentially extending that. Also Apple earnings, of course, and one that I never thought I'd say is SanDisk earnings tomorrow morning. It's been a moonshot on this AI and memory trade.
Western Digital and Visa as well tonight. Let's get to the judge.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, plunging Microsoft. The stock suffering its worst day in some 6 years. We're trading that and the rest of tech with the investment committee. And joining me for the hour today, Josh Brown, Jim Lebenthal, Malcolm Etheridge, and Rob Sechin. Let's take you to the markets. It is a tech and NASDAQ story today, down about 2%. So we're obviously watching the dramatic moves that we continue to see in metals and copper and gold and silver, and we will get to all of that. However, Microsoft, as we said, on pace for its worst day since March 2020. That is when it was down 14%. We will track it throughout this day to see if it eclipses that. Why is this happening? Well, earnings season for the mega caps was all about the spend versus revenue growth, right? Strong revenue growth shows that you get the ROI on the spend that everybody's clamoring for. Microsoft had a higher than expected spend. The problem is they had a slower than expected cloud revenue growth. And Malcolm, that seems to be the issue in the market today. Jim, Malcolm, Rob own that stock. What do you make of the report? What do you make of the price action? And what you should do now?
I knew you were going to come to me first.
Yeah. Yeah.
So I was on with you yesterday, closing bell, and my focus was entirely on Microsoft figuring out a way to signal to the street. This is their first opportunity since the restructuring of the deal with OpenAI to say something, to tell a story that lets us know just how little they rely now on that relationship with OpenAI. They had taken steps in November, built a new partnership with Anthropic, the direct competitor of OpenAI. All seemed to be going well. And then all of a sudden, to your point, at the same time, CapEx is going up, revenue has come down, even if ever so slightly. And that was just enough for the street to say, thanks, but no thanks. Separately from that, though, I think what also needs to be part of the story is the additional $200 billion worth of RPOs that came into the conversation later on are from OpenAI. So just as I was saying, it's time to start talking about how you're better off without them following the separation. Here we go. We're even more reliant. And I think both of those things taken together, the street just said, enough's enough.
What's your take?
This to me seems well overblown. If we measure it by market cap, Microsoft has lost about $400 billion of market cap today. And why is that? That's because Azure, at least in part because Azure disappointed by about 1 to 2 percentage points relative to what was expected. Now, the expectations, they said 39.5% growth, but the whisper numbers were more above 40, 41%, came in around 38%. So we're going to take $400 billion of market cap off of Microsoft because the Azure revenue growth was 38%. And some of that disappointment came from supply constraints. We know that they can't get as many GPUs as they want. They're trying to parcel these out between the Copilot business and Azure. Again, I put this all together. I use those numbers specifically to say this seems overblown to me.
I mean, I think you oversimplify it a little bit. It's suggesting that the stock is only down because revenue growth for Azure was just down slightly. You miss the fact that spending was greater than expected. And how can you have one versus the other and not have a reaction like you're having now? We've been talking nonstop about the tremendous spend that these companies have and the return on investment that they are going to see. So if your spend is increasing and your revenue growth is decreasing in terms of where the estimates are or not meeting what the estimates are, therein lies the rub.
Yeah, I mentioned Azure specifically because I was thinking about what you said, Scott, about return on investment, ROI, and we need to see it. We didn't see what the street was looking for in terms of the whisper number in terms of Azure growth. But again, to me, what I'm looking at here is there's a supply constraint issue going on here. Supply constraints have happened many times over the last 3.5 years since AI became, a thing. They will happen from time to time, and then they work themselves out. And I think once they do, that ROI will pick back up. But I do want to use these numbers again. 38% year-over-year growth in Azure revenue. I find it hard to say that I'm disappointed, even if the street wanted 40, 41%.
But I think, Jim, the reason that that's not good enough is simply because people like me have been making the argument for some time now that the thing that really matters to the Microsoft story right now is Azure cloud credits and their ability to sell those, regardless of whether they can monetize Copilot or any of the other enterprise tools that are AI-based, and that buys them some runway. With Azure growth stalling or slowing, that tears that thesis up, and it says that we need to show a way to monetize that AI spend sooner than later.
Down 12% today, and with the stock now trading in the mid to low 20s on a forward multiple, depending on whose earnings estimates you use. I'm going to say to you that your point is well made, but because I think it's temporary and it's generated by supply constraints, that this is overdone. It will take some time. I'm not rushing out to add to my Microsoft today, but I think by the time we're in the summer and these supply constraints have eased, you're going to see this snap back. This is just overdone.
So, Rob, Morgan Stanley removes it as its top pick. It still likes it. It's firmly overweight, it says, but it is no longer a top pick. Bernstein says solid quarter and guide, but not good enough, to Malcolm's point. Trim's target to 641 from 645. Yes, they are still outperform. But what's your take? Because you own the stock too.
We own the stock big. I don't think we can change that. We've been in the name for a very long time.
You want to change that?
No. I think we could trim it at the margin. We have not. We've chosen not to do that. I think our view more aligns with what Jim's saying. There's no doubt that there was some tactical pressure on the name, and that just shows you that when you disappoint, even at the margin, even though everything else was solid, the room for disappointment is about this big. And can you monetize AI? That's another question for some other names. Some are showing that they can, others are showing that they can't yet. It doesn't mean they never will. businesses, getting killed in the last several days.
Yeah, we'll get to those coming up too. We will.
Right. But the reality of it is with Microsoft, we're going to stay a holder. We tend to be in Jim's camp. We're a little worried near term, but we're not jettisoning the position. They have consistently benefited from their role in the ecosystem, which is not only great endemic across every business, but continues to expand, whether that's expanding at a rapid pace like Azure.
It's also a reflection of a lot of the fear around things like, can OpenAI pay its bills? I don't think that's going to change, quite frankly. I think throughout the balance of the year, that remains where the landmines are. But I think there's a bigger point here that's more important for everybody, whether they're long Microsoft or not. This is a really healthy market environment where the Mag 7 are not trading as a monolithic thing, and you've got massive separation. I want to share a stat with you from my team. Microsoft down 12%, while Meta up 8%. That is a 20% spread. If they close here, it would be the second largest daily spread between those two stocks since Meta came public. And the only greater spread was on a day in 2013 where Meta was up 30% on the session, with Microsoft down 1%. So we really have never seen an earnings season where these two names have diverged to the degree that they are. And I think this flies in the face of the people who have been complaining about, oh, it's about index funds, it's ETFs, there's no price discovery, the market's being manipulated by Vanguard and BlackRock and the flows. No, actually, people are making rational buy and sell decisions on results. And we'll do Meta in a second. Yeah. As narrow as Microsoft's miss was, and let's face it was pretty narrow, Meta was not like a blockbuster
and they all came into this week down for the year.
Yes.
So results matter.
That's right. So wait.
Microsoft was up 7% since last Friday.
But this is the takeaway for me, though. That's good news. It doesn't take much of a beat to get an outsized reaction like we're seeing in the for Meta to the upside. Doesn't take much in either direction, which is good for investing, I think.
So yes, the stocks, to your point, Rob, were still down on the year, which is obviously very young. However, over the last week, they were all up. They were all running into the print. Now, Josh says that Microsoft's going to be, his words, in the cooler for 90 days. Microsoft is last quarter's Meta. Because if you look at the drop in Meta last quarter, it looks exactly like that. Because there were the same questions. 100%. You're spending like crazy, and we're not convinced.
Meta guided higher on spending too.
We're not convinced that you're going to see the ROI fast enough to justify what you're spending. This time around, however, is different. Yes, they showed a big pickup in spend, bigger than expected. They showed a bigger than expected pickup in revenue growth too. And that is the story. That is why that chart looks like that. After looking at the far left like it did last quarter, they seem to be answering some of the most serious questions about what is happening there. Rob, you own this name too. It really is. Like Microsoft was Meta last quarter. Meta seems to have answered the call, so to speak.
Different to where they are in the hierarchy of monetizing AI, though. If I look at Google and Meta, which are our largest overweights of the Mag 7, versus any of the other Mag 7, they are really at the front lines of using advertising and marketing to see an enormous, if you looked at the Meta numbers, there was an enormous pickup in adoption, right? So if you're able to monetize quickly, which is really where it resides, you will have the ability to have an earnings report that looks like you're healthy.
Well, Meta's revenue is 97% advertising.
Correct.
So it's very different from Microsoft.
Totally.
Right.
But when you think about the progression of who's been monetizing it the fastest, Meta has seen rapid acceleration there. Google Alphabet has seen massive acceleration there. Some of the others are not seeing it. It gets back to your original question, is can the spend be justified? And it is there.
So Bernstein comments on Meta, says,
9 upgrades.
All the core does is win, win, win no matter what. They raise their target to $900. They were at $870, so they were already really bullish. But they go to $900. They reiterate their outperform rating. Jimmy, what did you want to say earlier? When you look at this, the difference of what these companies are doing, it's so striking that Meta was, last quarter's egg all over the suit stock, and here it's Microsoft this time.
So we're obviously seeing, and we've talked about for quite some time, that this is not the monolith, the Mag 7, that it was. And I think, Josh, that's what you were saying. I just wanted to extend it one step further, which is to say, the market overall is not getting killed by this. Yes, the NASDAQ is down big. But many of us, I think all of us have wondered over the last year or two how this concentration at the top of the S&P 500 would resolve itself. And there's been a worry that Microsoft down 12% would create a cratering effect for the rest of the market and bring it down. The RSP, the equal weight S&P 500, is flat. Small caps are down only 0.3%. And it's showing, to use your word, a healthiness in the market, that we can have this correction in the concentration without an absolute bloodbath. I think this is healthy, honestly.
I think the points have been made, and the stocks have proven this out more recently than over the longer period, that there are idiosyncratic things that are going to be punished.
Well, look, Meta is a user of AI to improve its algorithm so that it keeps you addicted to Instagram longer. Microsoft is selling other companies the ability to utilize AI in their cloud environment. So right off the bat, these are not comparable, other than the fact that we've all decided, oh, they're hyperscalers, or oh, they're in the Mag 7, or the Grade 8, or whatever we're calling it these days. But like, every one of these names has its own cons, pros, different drivers. Like, is there really a lot of similarity between Meta and Microsoft in real life, other than size and scale? Not much. And I think that this bears that idea out. The thing that's interesting about Meta, though, 2026 is still an important year for them to actually deliver on the model front, because they've spent too much money not to. And so they've made this big investment in Scale AI. They brought on Alexander Wang. They're talking about like the next generation of language models, et cetera, et cetera. They do at some point have to be able to show, yes, $135 billion in CapEx this year, but we have a new product that's revenue generating in and of itself, and it's not just, hey, look, cooler Instagram. So they have to do it at some point this year.
We do have a problem in software. I mean, quite obviously. And Microsoft is making it worse, undoubtedly today. The IGV, that is the software ETF, and we show it to you a lot. Let's take a look at that instead of that. Worst day since April 4th of 2025. And it's not just Microsoft. You got ServiceNow, Malcolm, which is down after its report. They did raise their guidance, but this one and CRM, Salesforce, have been really in the eye of the storm, where conversations are taking place about AI allegedly, quote unquote, killing software. And I don't know what reverses that. The commentary on Now was good, but not good enough. And that is the overriding factor in all of this. Good report, okay, fine. Not good enough, not now, not with these questions being asked.
I picked the wrong day to be here, obviously.
Well, we need your insight, so it's the right day.
So I jumped into ServiceNow down 30% over 3 months or something, and I said out of my mouth on this show, this represents peak pessimism to me. I thought that the sell-off following the Armis deal announcement was probably as bad as it got. I thought it was also overblown, because I can see where Armis would be accretive. And now we're down another 12 or so percent, depending on where there it is, 11% right now. So it doesn't look great. However, I will say Bill McDermott did everything he could. He directly addressed, we're done making acquisitions for the foreseeable future. I am done with M&A right now, and please give us back our market cap. And the street did not care. And so I think that it has a lot more to do with sentiment related to them trying to acquire their way into being a AI competitor versus growing it organically. And I think eventually a narrative has to change to
I don't think there's anything different that they could have done. The stock would probably look the same. Oracle is in a 50% drawdown. So much for all the bubble talk. Hard to have a bubble when Oracle's cut in half.
Look at CRM.
CRM's in a 42% drawdown. It's the worst drawdown since 2022, and that's with activists re-engaging. Doesn't matter.
Broaden that out. You can see a straight line of nothing. I think if you back it out for a year, look at a one-year chart.
That is a slope we've skied, by the way. I mean, it's a core business. There's high switching costs.
Well, you came down that slope
Yeah.
doing the downhill, and your helmet's all, and your skis are all over the place.
I don't know if it was
and
a total.
You're in the netting on the side.
I don't know if it was a total yard sale like that, but I got to tell you, we've experienced it. We haven't lost faith in it. We probably should have a while ago. But the reality of it is it's core to our ecosystem and everything we do. It's core to a lot of ecosystems out there. There's enormous switching costs. And if you're thinking about a hedge to the new way of doing things, those hedges generally are in the form of price and businesses that are important. And by the way, if the narrative pivots, these are going to be benefits that benefit. In addition, Scott, just one more quick thing.
Yeah, I want to mention another stock.
They are trying to embrace AI. We're seeing it through our ecosystem. It's not as effective yet. There's some tip of the spear companies like Google and Meta, but there's others that are going to take a little longer.
I want to show you IBM today too. And let's just look at the intraday for a moment. So there's the 6% move today, which is dramatic in and of itself. But pull this back out to, let's try 5 years. Let's do 5 years. Because this, to me, more than so many other names, is a, we will show you. We will show you. After doing nothing in 22, doing nothing in 23, they're like, we got this. We know how to integrate Red Hat. We know how to do AI better than most. And the street, I don't think, was sold on that until the last few years when that move, credit to Stephanie Link, who's been in this name for a long time, Rob, Malcolm, now you feel better, Malcolm, blowing you up a little bit on this one. But, man, they've delivered. They've delivered. What do you guys say about this?
I got to tell you, we added it on the show last year because we thought it was a cheap way to get this exposure. And by the way, it really was. And it's up, I think, 47% since we've talked about it. The PE's obviously expanded, but it's another company that is not being disrupted as much by AI. They're embracing it and well positioned to benefit from it. It's starting to be reflected in their numbers. And we think today it justifies the valuation. Their conservative guidance is not too surprising. That seems to be a little bit of their history, right, in the way they do things. But they've pretty consistently been delivering.
Didn't they go through quarter after quarter after quarter after quarter of no revenue growth, disappointing at the very least? And that's why the stock looked like that for a few years. And then Arvind Krishna, the CEO, has just done, I don't think you can say anything less than a masterful job. And people don't talk about him as much as they, try and blow up some of these other CEOs, but you better put him on your wall of fame, given what the stock has done.
What I thought was attractive about this one when I jumped into it, their AI book at that point was about $2 billion. And it made sense to me that as we were getting excited talking about all the hyperscalers spending all this money to build out data centers and everything else to run AI, you needed someone to come alongside you as an enterprise and teach you how to actually use the thing that you were deploying within your company. And so that to me was where it made sense for IBM to come into the picture. Fast forward, they jumped from $7.5 billion in the AI book to about $9.5 billion previous quarter, 12 and change this last one they just reported. So they're more than double from last year where their AI book of business was. That to me is where the growth story is in IBM.
All right, I'll come back to this in a moment. We have breaking news down in Washington on the Hill. Emily Wilkins has that for us. Em, tell us more.
Hey, Scott. Well, the Senate has now failed to advance a measure that would keep a good chunk of the government funded after Friday at midnight. But we do know that there is a plan B in the works. We know that Senate Democrats have been meeting with Trump's White House to try to figure out a path forward. We've heard one potential thing to do might be to move there. Remember, there are 6 funding bills in this package. Move the 5 with strong bipartisan support, and then just do a very short-term bill that would just fund the DHS, maybe for only a couple weeks, while lawmakers try to work out longer-term reforms. Now, that's not official at this point, but we do know that discussions and negotiations are ongoing. Of course, timer's ticking down at this point. You've got less than 48 hours until we would officially be in a shutdown. There is hope that if we're in a shutdown position over the weekend, that it would be very short-lived. But of course, that's going to require the White House and Democrats to get on the same page. And while there's some optimism around that, we haven't seen a deal yet. Scott?
All right. Emily, thank you. Emily Wilkins, clock ticking clearly. We do have more breaking news. Eamon Javers has that for us also from Washington. Eamon?
Scott, that's right. President Trump is having a cabinet meeting right now, and just moments ago, he gave us a new window into his thinking on Fed share. The president said he'll announce a new Fed share next week sometime. He didn't put a precise date on that. We don't have any indication of anybody he's favoring or not favoring, but the president said a short time ago that he'll be announcing the head of the Fed, who will be a person that I think will do a good job. That doesn't give us much to work with, Scott, in terms of who are the remaining 4 candidates he might be thinking of, but it looks like that deadline, which had initially been set as sort of January sometime, is now looking like it's going to be February sometime.
All right. Well, we'll see. Reeder, Waller, Hassett, and Warsh, and we'll see who gets the lucky golden ticket.
Final 4.
Eamon, yeah. Eamon, thanks. That's Eamon Javers. All right, let's turn our attention before we get out of here for this break to Apple, because that is the biggie tonight. How about this? JP Morgan's Retail Radar. Retail investors turn the most positive on Apple for the first time in 3 months. That's interesting, considering the stock has been, I think, in an 8-week-in-a-row drawdown, which has been painful to watch. Steve Kovac is always in Cupertino on this big day, and he is yet again. What do we need to watch out for most of all, Steve?
Hey there, Scott. Yeah, most of all, first of all, we know it's going to be a blockbuster quarter for that iPhone business, the iPhone 17. Double-digit top-line revenue growth that's going to contribute to that. It's been a really long time since we've seen that kind of growth come out of Apple, especially in that super important December quarter. And then we turn our focus over to AI now that we know the iPhone picture and that new partnership with Google's Gemini service that is going to be moving forward, powering a lot of the Apple Intelligence features, including that delayed version of Siri that's been delayed at least a year now. That's going to be launching, we expect, within a few weeks. So hopefully some more details on that. You guys have been talking so much on the show so far about monetizing AI. That is still unclear how that works over here at Apple, because they're going to be giving the system away for free. Apple Intelligence comes included in your new phones. So at the end of the day, whatever comes out of this new Gemini relationship is going to have to move new phone sales, just like we thought was going to happen last year. And then finally, on the tariff front, we are expecting or Apple said to expect at least a $1.4 billion tariff bill. That's on top of the several billion they've already paid so far. No SCOTUS decision yet. That's going to really impact that. And then also just one more thing to look at is these memory prices. We've been talking, Samsung reported last night how memory prices are going through the roof. We're watching SanDisk earnings and so many others. There have been some consternation on the street lately about how that might press Apple margins. So we'll be paying attention to that too, Scott.
Yeah, I mean, someone's pain has been Micron's gain. That's for sure, because that stock's been ripping too. All right, Steve, we'll see you later. Thank you. Steve Kovac, Cupertino, as always. You want to comment on this one for us?
Yeah, I think the thing with Apple is last year's problem is this year's benefit. So last year, Apple's under pressure. What's their AI strategy? And by the way, I'm not making fun of everyone. I was saying the same thing over and over again, and I'm a shareholder. But like that was the story last year. What's wrong with Apple? Why can't they do this? Okay. Fast forward a year later, and now all of the spending they did not engage in looks like sort of wise. And let's not forget, in the end, they are the gateway for every one of these AI apps and products and services. They're getting paid on anyone that wants to work with consumers via the iOS ecosystem. They're sitting there like the world's gatekeeper to the wealthiest consumers all over the world, and that hasn't changed. And some of the pressure's off. They're going to work with Google. It's a partner they've worked with for 20 years. And quite frankly, I don't know when the Siri upgrade will come. The street doesn't seem to be as worried about that. They got an iPhone sales cycle. They got record services sales, record margins on the services business. And whenever they get around to figuring out their own internal AI strategy, at this point, it looks like it'll be good enough for everyone.
What do you think?
I'm taking what he's saying a little further, all right? It is a great company. You often hear us on this
Wow,
show.
you're really
talking,
going out on
No,
Apple?
just hang on, just because we don't
Jim,
have much
how
time.
long did
We don't
you-
have much time.
how
all right?
long did you
Seriously.
think about working
Hang
that
on,
one up?
Okay, you guys are hilarious.
How many
For
donuts
people-
on the tractor in the snow?
I
How
like
many
donuts,
did it
but
take
that's
you
not
to
what
come
this
up
is
with
about.
that?
For those people who don't own Apple, just consider this, all right? And if we could put up a 20-year logarithmic chart, that might ask too much. But I'm telling you, this stock goes up over time. It's a great company. You hold it over long periods of time, and you don't worry about, hey, it's 34 times, and it has to come down to 29 times earnings. That's irrelevant. The 20-year annualized stock return is 27%. Annualized over the last 20 years, the S&P 500 is 11%. I see no reason that doesn't continue, given what you were just saying about it, Josh.
20 years?
20 years.
Did you consume another Red Bull before the show?
I did not. I only had one espresso because last time I thought maybe the Red Bull
Maybe
went
cut
too
that
far.
back to
I
a
like the
decaf.
conviction.
But here's what it comes down to. iPhone
Real quick,
sales
I gotta bounce, but
iPhone
go
sales
ahead.
have been stronger than we expected them to the last 4 quarters, and that's kept the Apple story alive. That's really what it is.
It's a premium valuation
gotta-
relative to the growth
I gotta
rate.
go. I gotta go.
We're going to have to leave it there, Rob.
Josh has a move. We want to tell you about that, and we got to pay some bills in the interim. So we'll come back. Josh making a move. I've got some committee stocks on the move. I got some calls of the day. I've got Josh's best stocks in the market. The list is long, and we'll get to all of it. Busy day of breaking news, and we have even more. To our Leslie Picker. Leslie?
Hi, Scott. Yes, we have obtained a statement from the former CEO of First Brands following the indictment against him and his brother, who was an executive at the now bankrupt First Brands. He says, according to a spokesperson, Patrick James is presumed innocent and denies these charges. He built First Brands from nothing into a global industry leader and has always been devoted to the success of the company. Mr. James looks forward to presenting his case in court. The indictment, of course, filed in the United States District Court, the Southern District of New York. It alleges a bunch of different counts, about 9 counts total, among them that he and his brother yielded billions of dollars in financing to First Brands and reaped millions of dollars in proceeds derived from frauds, and a lot of that related to allegedly fake and false inflated invoices for accounts receivable and payable, double and triple pledged loan collateral, falsified corporate financial statements, and concealed substantial liabilities from lenders. Now, if you recall, Scott, this whole bankruptcy kind of unleashed the concerns around credit, private credit, as well as syndicated credit as well back in the fall. So this is just the latest development here with the indictment and now a response from the former CEO of First Brands. I'll send it back to you.
All right. Yeah, I appreciate you following that story for us, Leslie. Thank you. That's Leslie Picker. I mentioned some moves. Take a look at Joby Aviation today. The stock, at least earlier, was what we would consider to be tanking. I mean, it's down like 18%, right? They're doing a share sale. Josh Brown owns the name, and he has looked at that and said, I want to buy more, right?
Yeah, well, so this is where I originally bought it. It ran up to 20. I didn't sell any because I'm not that smart. But this is not a trade for me. I've talked about this as a very, very, very speculative situation, but an investment because I do believe we are going to see a thriving eVTOL business probably by the end of the decade. So what Joby's doing now is they're taking advantage of this opportunity to raise capital while they can. The terms are fairly favorable. Unfortunately, it's dilutive when they do that. And I have no crystal ball about how many more times they'll have to do it. But I would say they've raised more money than any of the other pure plays in the space. They actually have revenue because they bought the Blade helicopter business, and the proceeds from this sale are being used. It's a convertible and a share sale. The proceeds are being used to actually commercialize their eVTOL and get the service up and running. Within 60 days, we're going to see these things in the skies over the deserts in the Middle East. Won't be long before we'll see them here in the United States. And I think Joby is in the best possible position because they're vertically integrated. They're not making these to sell them to somebody else. They are themselves going to operate the taxi business. And it'll take a while before you get on one as somebody who's watching this. But a speculative investment like this, I think, when you get an opportunity down 50% from recent highs, you got to add to the positions. That's what I did.
You sold Planet Labs completely?
Yeah. So that was a double from where I bought it, and I talked about it on the show as sort of like an ancillary play to the low altitude economy. It made a new record high 2 days ago. I looked at it coming in today with the overall market, and I just said, you know what? Let me reallocate and add some more Joby here. I can revisit this Planet Labs. Who knows? Maybe they do a secondary, crush their own stock. Maybe that'll be another entry point for me. But the stock worked out really well in a short period of time, and I'm just saying au revoir.
All right. Well, thank you for that. Merci beaucoup. Okay. Lockheed Martin. Just trying to play along with it. Lockheed Martin raised their outlook. Jimmy, this is you, and Rob owns it too. Jimmy, quick, and then Rob.
Yeah, raised their outlook, and they entered a new production scheme with the government where they're going to quadruple their missile production. I mean, this is the stock to own. It's up about 25% year to date. It had a terrible 2024, which it's snapping back from. Excuse me, a terrible 2025. Rob, you want to take it?
Yeah, I mean, names like this, names like Karman Holdings, which is a newer, higher beta way to play this KRMN, are just absolutely benefiting from increased defense spend. A lot of these came into the year. We increased in December on this show with much more reasonable valuations. Deliveries were accelerating. They were working through some of their supply chain issues with the F-35 fighter jet. They're a pure play on this. It's a great way to continue to play this space.
What about Lilly? Target gets bumped from $960 at Cowen to $1250. They reiterate their buy. What about this name?
Yeah, tough year so far, but the good news is that it's re-rated quite a bit. You know, last year Lilly got all the way up to 53 times earnings. We're back in the 33 and change range, and they have great gross margins, healthy operating margins. We're neutral right now, but we continue to expect them to be a front runner in GLP-1 on an ongoing basis.
All right, let's get the headlines now with Seema Modi. Hi, Seema.
Here's what we're watching, Scott. The U.S. Navy sent an additional warship to the Middle East as tensions rise with Iran over nuclear negotiations and its deadly anti-government protest crackdown. Now, an official telling Reuters that USS Delbert Black has entered the region in the past 48 hours. This brings the number of destroyers in the Middle East to 6, along with an aircraft carrier. The Associated Press is reporting President Trump is considering locating his Board of Peace at the Washington, D.C. building that formerly housed the U.S. Institute of Peace. It comes as former employees and executives fight the Trump administration's takeover of the nonprofit in court. Now, 27 countries have signed up as founding members to the board. President Trump says its first task will be overseeing the Gaza peace plan. And the CDC said today the U.S. life expectancy hit a record high in 2024. According to the report, the age has risen to 79 years old, which is up half a year from 2023. Women are still expected to live longer than men, with life expectancy increasing to 81.4 years compared to the 76.5 years for males. How about that, Scott?
All right, Seema, thank you. That's Seema Modi. Coming up, Josh Brown's best stocks in the market, doubling down on a name that got crushed on earnings. The details are next. All right, let's do best stocks in the market. According to Josh Brown, we are in the materials area today, and it is ticker symbol NUE.
Yeah, materials have been on fire for a minute, and this name on the best stocks in the market list. And I feel like you learn a lot from watching the reaction to earnings in a name like this, because it gapped down 6% the day they reported a quote-unquote disappointing number for last quarter. But that's algorithms. What happened later that day is the buyers looked at the commentary about backlog and 2026 business, and they snapped it right back up. I think it ended up closing only down 1% on the day. And when you see action like that in a company that allegedly missed, you have to pay attention to what the buyers and sellers are telling you. I really like that price action, and I think the story here, the steel mill segment They operate in 3 segments. The steel mill segment is talking about a 40% backlog growth number year over year, and the steel product backlog grew 15%. All 3 of their businesses are going to post growth this year after many, many years of very spotty, variable type of growth. And it's just basically a company that's in the right sector, has the right technical setup. So I do think you're going to get a new high here in the name. I think it'll run through that 180 resistance like a hot knife through butter. And if and when it does, this name's going to land on a lot of people's best stocks list, not just mine. And I think you'll see follow through in that accumulation.
This is like catnip for Jim. I mean,
he loves this kind of stock.
Well, he likes
scrap
Cleveland
metal.
Cliffs,
You love this, right? This is your,
I do.
This is your whole thing. I feel
I
like
do. It's simple. It's simple to understand. It's costs that you pay to produce the metals and the prices that you receive when you sell them. And prices that you receive have been going up. Whether that's due to tariffs or not, they're going up. You're seeing demand slowly pick up, and you're seeing that in some of the commentary from Nucor.
Cliffs is up 40% over the last year. Now, I mean, I'm sure I think it's down a bunch over a longer period of time. But
I'm going to give you some catnip.
What's the 20? I'm just looking at it. 40%. It's up 40%.
And you know what?
But look at a bigger picture.
I think that from here to the year end, you're going to see more gains. But catnip for you. I'm gone next week. You know that. I'm skiing in the Alps. I come back on Monday. I'm with you. And Cliffs reports on the Monday. I'm back. Okay, so do you think it's going to be a happy welcome or a sad welcome? Lorenzo?
I'm surprised you didn't extend the trip just in case.
I have faith. I have faith. Actually, in all seriousness.
We'll get you via remote.
In all seriousness, they're controlling costs. There's been a lot that's been holding them back over the last year, and I think they're going to shine through.
Okay, so I know where you're going, so you need your passport, and we need our passports today for ETF Edge. We'll explain coming up.
Welcome back to the Halftime Report. I'm Dominic Chu with your ETF Edge. While some have called recent outperformance of international markets just a catch-up trade, there's a case for more fundamental investing changes afoot. Joining me now is John Mayer, the chief ETF strategist over at JP Morgan. So, John, let's talk a little bit about what is driving that international outperformance. Is it just dollar weakness, or can we count on more momentum?
Thanks for having me. I think that international markets are going to continue on their trend going forward. There's certainly the dollar story that you mentioned a moment ago, and we're projecting that dollar will devalue about 1% annually over the next decade. Also, valuations remain really strong. International equities trade at a 32% discount to the U.S. versus an average of 19% discount over the last 20 years. We see opportunities in financials, energy materials, and select industries. And valuations for international value remain very, very compelling. And we think that will continue going forward.
John, just a few moments left here. Are there any specific ETFs that you are keying in on this time around?
Yeah, we have International Value Fund. The ticker is JIVE, J-I-V-E. This was one of our top performing funds last year. We believe that value in the international space has a low correlation to U.S. large cap growth. So that's a nice pairing. And it had about $1 billion of inflows last year. So we're expecting that to continue. The ticker is JIVE.
Gotcha. All right, perfect. Thank you so much, John Mayer over at JP Morgan. This conversation continues over at etfedge.cnbc.com, where you can get more insights from John, along with Tim Seymour over at Seymour Asset Management. And tune in again Monday for our next installment, Scott. I'll send things back over to you guys.
All right, we'll do that, Dom. Thanks so much. Santoli is next with his midday word. All right, welcome back. Senior markets commentator and overtime co-anchor Mike Santoli joining us now with his midday word. It really is interesting how we're suggesting that Microsoft is last quarter's Meta. Just the way that these things have reacted is really similar.
For sure. And I just think it reinforced the inclination of the market to just be suspect of, the OpenAI kind of voracious capital consumer buying hardware at a massive upcharge, right? Which is kind of what you're seeing in the memory chips. And so it's one of those things that I think feeds the anxieties of the market. To me, the key is it was a tremor, kind of a warning shot. Maybe this is how the big one starts, but the rotation kicked back in. So it looked like a couple hours ago it could have been more of an across-the-board selling event. The equal weighted S&P is about flat right now. Gold and silver cracked briefly. They try to get their footing. So I don't know. I think it's a little bit of a preview of maybe how we ultimately get an actual correction. But for now, it just seems more like the rotational churn.
Yeah, we'll see how the day progresses. It also is interesting, too. It's not, Microsoft is not necessarily I get that it's down, but the market is hanging in okay. You know
no, it is, without a doubt.
Yeah, all right, I'll see you later. That's Mike Santoli. We'll do finals next. Got Apple, those earnings in overtime, obviously. We'll count you right down to it. Dan Ives, Alex Kantrowitz, Anka Crawford, and Kevin Simpson. I hope you'll join me then at 3 o'clock Eastern time for the closing bell and the final stretch. Rob Seach, it's good to have you back, man. It's been a minute. What do you got?
Let's go with Blackstone. Great results, and the exit environment's improving. Only trades at 22 times.
Okay, Malk?
I got IBM software and AI consulting that represents more than 40% of their revenues. Go blue.
Figured you'd focus on the one that looks nice and green today.
He learned that from me, Judge.
That is the trick.
Farmer Jim.
Cisco Systems, no matter what the ROI for Microsoft and Meta, Cisco Systems will benefit from that CapEx.
Okay, XOM.
ExxonMobil, this is our last impression on the show. Never leave the viewers with your face next to a red stop. What's wrong with you? It's your first time?
All right, that does it for us. I'll see you on the bell. The exchanges now.
Thank you very much, Scott. Meta's mega print, Tesla's mega pivot, and a mega plot twist in the dollar story and the chart that explains it. Welcome to The Exchange. I'm Kelly Evans. Let's start with the market. Some big moves today. And in fact, we're largely struggling in the red everywhere, as you can see, amid another big sell-off in the software names. The NASDAQ was down more than 2% earlier. The Dow, for its part, is actually only down about 0.4 right now. The 10 years below 423. Now, Microsoft and the software names, the likes of Salesforce and ServiceNow, those are leading the declines today. The IGV ETF is down 6%. Microsoft is down almost 12% for its worst day in more than 5 years. A hat tip to the trader who's been messaging me for weeks saying the stock was acting like a miss was coming. It certainly was. I don't know if it's a miss, but it's continuing to act like there's a real problem in the growth trajectory here. Bear market territory for the IGV ETF, by the way. We're down 20% from the recent highs. On the flip side, social media is a standout, with Meta jumping on a big revenue and guidance beat. It's up 9.5% now, and Apple is coming after the bell today. The shares are kind of a standstill into that print. We're also watching a big reversal in the metals trade this morning. After gold crossed 5,500 for the first time, we're back at 5,337 right now. But copper has levitated. It's now surging to a new high, up 5% to its best day in more than 17 years. So let's begin with the outperformer, Meta. The shares are up 8% on a big revenue and guidance beat. The move higher despite big CapEx spending plans that could total $135 billion this year. But my next guest says the results prove the spend is justified. He said buy into the print earlier this week, and he just upped his target today to 1,000 from 910. That makes him one of the highest on the street. Let's bring in Brent Thill, Jefferies tech sector research analyst. Brent, a hat tip to you, and this goes back to what we were saying yesterday. It doesn't have to be that the shares are strong if they pull in CapEx plans and weak if they don't. They just have to justify the CapEx plans. So to those who are now questioning whether this pace of spend can literally be sustained by their cash flows, what do you tell them?
It can, and we think the stock's going to 1,000. They're going to do $36 of earning power, and you can actually lower the multiple on it and get a much better outcome in terms of the stock.
Is this all because when certain friends of mine are on Instagram, Instagram's algorithm has improved, its ad load is higher, it's just printing money as a result? Is that what's going on here?
Yeah, I think the investments in AI have really paid off. When you look at it, they've been investing in AI, and that's paid off in terms of keeping you on the platform and letting advertisers connect with that community. And going forward, I think the world of this immersive internet and world that they're creating is so different than what Google and others are creating. So we've said that I think the future of what Zuckerberg is trying to create is one that aligns with our view, which is it's differentiated, it's unique, and that they can monetize this, and that they've proven that the first wave of AI has paid off. Now the second wave of AI, can they make that work? And I think Zuckerberg was interrogated multiple times on the call, can this pay off? And I think he said that we don't really know yet, but I do think that this will pay off. We believe in a shared vision of what they're trying to create.
Yeah.
And they're demonstrating that, and you're seeing an acceleration in revenue growth. So the most important thing you're seeing is that acceleration.
Absolutely, and I take your point. It's the NVIDIA story to some extent that, the multiple's going to go down because of what you see going. We could dwell on this, but I just want to ask you about Microsoft, which you also cover. Horrible day for the name. It's been trading poorly for months, frankly. Probably an OpenAI problem. Maybe it's a software problem. But I look at your write-up of the quarter, and you saw a lot to like here. Am I wrong about that? What's the disconnect?
The disconnect is there's an inflection in Meta's growth, an inflection in semiconductors, an inflection in energy. It's not that Microsoft is bad. It's just that the numbers are not inflecting in AI. And so what you're seeing is money moving to other names. You're seeing money moving out of software. Our desk at Jefferies is massively for sale, not from just hedge funds, but long onlys. And we are seeing a capitulation in long only selling. So these are the big sticky long onlys that are effectively saying, "Uncle, I'm out."
Yes.
And that was not a down 12% print for Microsoft. It was a down 2 or 3. The problem is that there's so much more excitement going on when you look at Lam Research. You look at what's going on in the build out of infrastructure. Software has not come to AI has not come to software yet. And so I think you're not seeing positive revisions in software that you're seeing in semis and other sectors outside of our group. And so if we had a normal environment, the stock's down a couple percent. But I mean, look, their backlog, their signings, the contract commitments are great. Did Amy Hood maybe fumble in terms of the 45% of the backlog question? You know, what are they going to do with OpenAI? I think maybe that was a little bit of miss on their part. But she's phenomenal, and she's, again, among our favorites in the industry. So I think, you know, when she said, like, you know, you got to really ask the question about the other 55% of the business growing 28% and $340 billion of backlog is the right one to focus on. And so their business is really healthy. It's just software right now. Investors are worried that things are slowing before AI has even got to it. And what you're seeing is an inflection in other spaces. So we're just seeing one of those capitulation moments. What I've said is, in these moments, you kind of just you can't really do anything. You got to sit it out. And again, I think you're seeing, again, inflection in other places. So our tech team is focused. Names like Meta, we think Amazon's business will inflect in AWS. Google's doing phenomenally well. These infrastructure names in AI are still the place to be. And until the dust clears on the other sectors, I think everyone's going to stay away from that group, and they'll come back to it at some point.
Yeah, hardware is the new software. As Jim Cramer was saying again this morning, Victoria Green was talking about that on the program last week, and this is all stemming from the AI trade. So quickly, Brent, also on this issue about Microsoft's partnering with OpenAI, and again, we've asked since the launch of Gemini, if Gemini, which is powered by its own chips, is deflating the OpenAI trade. And again, Microsoft would seem to be hinting at, yes, it is. Does that mean that we should expect Alphabet to absolutely blow it out next week? Is the bar too high, or are they potentially doing so well that it's causing problems up and down the kind of OpenAI value chain?
I think it's pretty clear the OpenAI orbit right now is deflated. I mean, you look at Oracle, you look at Microsoft, the providers, there's concern. I think it's overly negative. And remember last Q1, Google, everyone thought AI was going to kill Google, and Google's one of the best performers. I think the sentiment's the same thing on OpenAI. I don't know why it's this negative. Yeah, Anthropic's doing well, and Google's doing well. But we've said there's going to be 3, 4, 5 vendors that do well. There's not going to be 30 because of the capital requirements and data needs and the number of users. And we think it's overly negative on the OpenAI orbit. If you look at Google, the bar is high, but what I'd say is that all the fundamental checks are phenomenal. Gemini usage, corporate companies going to Google, GCP, their technology. Again, I think this concept of that Google didn't have AI, they have more AI, more data, and more information on all of us across the world than any company on the planet. And that's what you need to make AI work. So they're in an incredible spot in my view. Yeah, is the bar high? Yes. Is it too high to clear? I don't think so. And again, we're incredibly bullish still long term about what Google can do. But I think Meta to us was the massive disconnect on the valuation. It was you could drive a semi trailer sideways through the disconnect in the multiple, and that's why we're why we're so constructive on what Meta's doing.
I know it's gratifying to see one come in like that. So again, it was great to have you on talking about it ahead of time, and now to see the fruits of that. Brent, appreciate your discussion today. Thanks so much.
Thanks, Kelly.
Brent Thill joining us from Jefferies there. Now let's get to some major changes over at Tesla, where CEO Elon Musk announced last night the EV maker will soon retire its Model X and S vehicles and repurpose that factory to build Optimus humanoid robots. Yes, it's a big deal. This move comes just as Tesla wraps up its first annual sales decline, with shares losing all their post-earnings gains as well. By the way, they're down 2.5% this hour. My next guest says, forget the Tesla you once knew. Musk has reached a definitive burn the ships inflection point. Speaking of inflection points, like we were just talking about with Brent Thill, let's bring in George Gianarikas, sustainability research analyst at Canaccord. There's no turning back, George. Is that what you're saying now?
Absolutely. I mean, there were two big announcements, in our opinion, yesterday. First and foremost, not really a P&L impact, but they are discontinuing the Models S and X, and those were instrumental to the company's growth in its early stages. And more importantly for the P&L, the company announced on the call that they're going to spend $20 billion on CapEx. That's more than 2x what they spent in 2025, and they're going to spend it to increase production for robots, for autonomous vehicles, for batteries. And that doesn't include potential spend on a semiconductor fab, which they sort of alluded to yesterday that they may build in the coming year. So this is a massive inflection for Tesla. I mean, they've always talked about this stuff, but to finally cut ties to the S and X, spend $20 billion in CapEx, and maybe even build a semi-fab, it's a pretty big deal.
Is it going to pay off? I noted you lowered your price target to $520 from $551.
We think so. I mean, but it does make modeling the company in the out years incredibly difficult relative to what we used to do. And we just sort of took vehicle sales, assumed a certain EV penetration, looked at what was happening in particular markets. But now it's a bet on autonomy and how many robo-taxis they could sell, what kind of penetration they get with the robo-taxis, how quickly they launch those markets, and then how many robots will they sell. And I mean, they're going to increase production to about 1 million of those by the end of the decade. And it's really hard to know. This is a brand new market. You know, there aren't many humanoid robots out there yet. And I mean, there's a lot of competition. We asked about that on the call yesterday, but these are moments in time where you have to make bets and sort of model things out that really don't exist today.
Would you rather I think this is why people love the stock. That's why they love Musk, right? That, he's never going to give you the boring, yeah, we beat the quarter by 2 cents and, here's our visibility to the out year, right? He's like, no, we're ending one production line and we're building humanoid robots. And also, I mean, Cybercab, is that part of this as well?
Yeah, so the Cybercab is going to be the steering wheel-less vehicle that sort of is the beginning of their robo-taxi moment. They will have Model 3s and Model Ys that can become robo-taxis, but this is the futuristic-looking vehicle that's not going to have a steering wheel, that's going to transport vehicle like an Uber does or a Lyft does in multiple markets across the country and eventually across the world. And what they said on the call yesterday, they plan to make more of those and sell more of those than they have every other vehicle in their lineup. So it's a really big deal. And what they're likely going to do, in our opinion, is own some of those themselves and have their own service, then potentially sell those to customers who can then tap into the Tesla network and create income for themselves by putting their vehicles onto the Tesla robotaxi network.
It's still a $1.4 trillion company, close to an all-time high for the stock. So, at this point, it's as much about the dream and the vision of Musk as it is about anything to do with. If you were to just literally analyze the financials in the absence of the genius of Musk, what would this company be worth?
I mean, look, they've been a disruptor in this market for well over a decade, and we've been asked this question: how do you value Tesla relative to the automakers? And you can sort of flip that question on its head and say, how do you value Google relative to media companies? How do you value Netflix relative to media companies? How do you value Amazon relative to retailers? It's a disruptor, and now they're sort of disrupting themselves, right? They're going to take a giant leap forward, get into new markets, probably be free cash flow negative in 2026. But you're right, you have to bet on Elon Musk. You have to look at his success in the past and assume that he can do it again. And it's not a coincidence that his compensation package was approved, and now he's taking these steps. I mean, these are giant bets for the company and literally world-altering products that he's going to put in the marketplace.
Yeah, and I forget how big the comp package is. How much could he stand to make if he gets this right? Because the fact that he hit the first one was hilarious. I mean, the targets were so high. Who would have thought he'd achieve it and then have a fight over it? And now the bar has been raised yet again.
Yeah, I mean, he's going to have a lot more money than I do. I mean, he'll be, very likely the world's first trillionaire if he does what he's set out to do.
All right, and the shareholders are, for the most part, want to be along for that ride. We'll see if he can pull it off again. George, thanks so much. Appreciate it today. George Gianarikas with Canaccord. Coming up, investors are turning their attention to Apple, reporting after the bell today. What to expect here? It's more of a hardware name. What would the spike in memory prices have to do with your next iPhone price? And the shares are down 10% from December's record high. Before all that, though, we mentioned what's going on with the metals. Some whipsaw trading this morning. Gold is way off its highs from the morning. Copper, though, is rising. Palladium's lower. Copper's at a record high and on track for its first 6-month win streak in 15 years. We'll look at the options market and what that's telling us about these metal moves. That's next on The Exchange.
This is The Exchange on CNBC.
Welcome back and check out the price action in precious metals. We've been getting questions about this all morning long. Gold, silver, copper all touching record highs today, but also seeing some big volatility this morning. Gold and silver are on pace for their best month in more than 45 years, by the way. Maybe Pippa Stevens can explain what's going on here, Pippa.
Hey, Kelly. So gold is at a new high after posting its 9th record close yesterday, and silver crossed above that 120 level before pulling back a little bit here. Now, amid this retail craze, GLD and SLV now among the top 10 most traded names. That's according to NASDAQ's retail activity tracker. Yesterday, SLV was the 3rd most traded name, just behind Tesla and NVIDIA. You can see it really stands out amid all of these tech names otherwise. But today's big talker is really copper, because earlier in the day, LME prices were up almost 12%, which would have triggered a limit up. That is something that has never happened before. And the magnitude of this move has been really astounding. If we go back, the run really began at the end of September, and prices are up 30% since. We first crossed above that $12,000 level on December 23rd, then $13,000 on January 5th, and then today we did get up to $14K on an intraday basis. Now, Albert McKenzie from Benchmark Mineral Intelligence told me it is really hard to describe to someone outside of this market just how baffling this move is. Copper is usually pretty stable. It is not a tech stack that can swing 10% in a day. And so a move like this is almost unheard of. He added that since this uptrend began back in September, basically nothing has changed on the fundamental side. So we could see a little bit of a decline going forward here, Kelly.
Come on, Ova. I think these are the questions on everyone's minds. They want to know, are metals prices soaring because the dollar is imploding? Are they soaring because there's been a big change in demand by key players like central banks, or because there's a shortage in all these big picture reasons, or are they flying because there's just a lot of speculators in the market now?
I think it started with people thinking about the dollar and maybe thinking about that debasement trade and then geopolitical tensions and the kind of quest for hard assets. But then it starts to feed on itself and really becomes this momentum trade. And so it started with gold and silver, and copper was kind of left out of it a little bit. And then today, something has happened. I mean, we saw a lot of activity overnight, particularly in Asian markets on the LME. That's when that price was up 11%. But copper just does not move like this. I mean, you can see something like that in a silver market, which is a little bit smaller. But copper has been, Dr. Copper, it's not the most exciting trade usually.
And I always feel like it's one thing to move shares of GameStop. I mean, who cares, right? But when you're moving the price of important kind of components of the global economy, it makes me a little nervous. Just quickly, I don't know if we can show the intraday. What happened this morning that all of a sudden around 9:30 it was like a $400 reversal in the gold price? I mean, was there anything significant, or is this just
it was nothing. It was just a
positioning?
lot of overnight trading that came from that Asia side if you look at the hours of when the activity took place, and then just a pullback. But it does speak to that volatility, that interest from retail traders. But one thing is that on copper and silver, there is actually demand destruction at a certain point. Gold is a little bit different. It seems like with silver, we definitely hit that demand destruction level already, but it does take a while for the spot price to then feed through into actual industrial players pulling back.
I expect to see more charts like from this morning, whether it's flash crashes or these crazy whipsaw trades, the way it's been trading. For now, Pippa, thanks. Pippa Stevens. Our next guest is watching the options market for the metals rally as the surge in volatility is driving this unusual pricing. For more on what he's seeing, let's bring in Chris Murphy. He's the co-head of derivative strategy at Susquehanna. Chris, what do you see going on here? Welcome.
Hey, well, you see something that we've really never seen before, which is implied volatility levels in silver above 100. I mean, I just looked at the graphic that you were showing with the silver move today. When implied volatility is above 100, you're expecting the underlying to move 6% on an average day. So today's move in silver is very, very much of a nothing when you compare to what it's expected to move. So we are starting to see some volatility selling in SLV. And, of course, the volatility can't go much higher. But when it is this high, you do see a lot of unique quirks with the pricing of options.
And when you say quirks, is there any way for the layperson to know? And I mean, to me, this smacks of memification of the metals.
Well, I mean, one quirk would be, if you bought puts a week ago, I'm sorry, if you sold puts a week ago and SLV traded up 20%, you would expect to make money on those puts because when stocks go higher, the price of puts should go lower. But the volatility of the SLV over the last 5 days or so is up so much. You have a situation where the underlying is up 20%, and those puts have become more expensive. You really never expect to see that. And that's, something you have to be careful for. If you say, okay, silver's finally making a pause, let's buy some puts here. If silver pulls back 5, 10, 20%, you might not make money on those puts because volatility could likely come in a lot as well.
So, I mean, and if this is kind of what I'm trying to say is, you're talking about unusual activity, stuff that doesn't quite add up. I'm just watching it going, this reminds me of meme stocks. And so what do you think the knock-on effect is going to be? Are people getting sucked into something that's, going to spit them back out? Or is there something more fundamental going on here? Is it the end of fiat currency and it's the devaluation of the dollar and there's, sound reasons why all of this is happening and we're all going to look back and say, yes, that was the breaking point?
Well, I mean, there's an element to the end of moves like this that is pulling in speculation, and then you could see silver and gold pausing today, and then you were asking questions on the earlier segment about the move in copper. Maybe we start to see the momentum players, the last players moving out of silver and into copper. So, we of course are watching that copper move today as well. FCX is a stock that typically people can use to play copper. We have been watching big bullish trades in there for a number of days and weeks now. So we're going to keep an eye on those trades, and we're seeing those trades being unloaded today. So, you figure someone who's making those trades has a strong opinion and on what's going on in the copper market. So to see them monetizing their bullish trades on a day like today, combined with silver pausing, volatility selling and pulling back, you could be looking for signs of some of this mania to slow down a little bit.
All right. For now, Chris, I really appreciate it. Kind of the signpost to a lot of the wacky activity that we're seeing. Chris Murphy over at Susquehanna. Coming up, the AI race is getting harder to predict. Big tech companies competing with the very startups they're also helping to fund. We'll take a closer look at that ahead and keep an eye on the broader markets because despite a lot of the red on your screen there, 10% of the S&P is at 52-week or all-time highs. Energy and materials, record highs there. Communication services, an all-time high for the first time since September. That's significant. More after this. Welcome back, and here's a look at the markets, which are well off session lows. The Dow was down as many as 418 points this morning. We're only down 134 right now. The Nasdaq down about 1.4%. It remains the underperformer, and it's not just the mega cap story there. It's the software stocks that have entered a bear market. They're on track for their worst day since April, worst month since 2008. They're down more than 20% from September's record high. Besides Microsoft, Atlassian, ServiceNow, Intuit, and Salesforce are all down big. ServiceNow is down 12%. Salesforce is at its lowest level in more than 2 years, and it's having its worst month also since 2008. It's also the second worst Dow stock over the past year, only behind United Health. It's down 40%, and it's down 20% since joining the Dow in late 2020. On the flip side, Royal Caribbean is leading the S&P today after forecasting annual profit above estimates. Investors thinking a rising tide lifts all boats, with Norwegian and Carnival shares also rising sharply in sympathy. And speaking of tech, shares of Microsoft are plummeting amid concerns about its exposure to OpenAI as well. They're down almost 12% today. Deirdre Bosa has more on their shifting relationship in today's Tech Check. Deirdre?
Hey, Kelly. So it used to be Microsoft's biggest boost in the AI race for years. It's now a source of anxiety. Feels like everyone's focusing on this RPO number. So let me break that one down. RPO, or remaining performance obligation, it's essentially backlog, revenue that Microsoft expects to recognize in the future from contracts that are already signed. The issue is concentration. About 45% of that backlog, it's tied to OpenAI. So when OpenAI looked like a locked-in exclusive growth engine, that was a feature. But now, with model commoditization, potential new owners at the table, like Microsoft's biggest cloud rival, Amazon, that starts to look like a risk. So investors are not just asking how durable is that demand if OpenAI's compute spend shifts or gets shared, but they're also wondering what Microsoft is doing to compete in the next leg of the AI race at large, which we're seeing it maybe less about models, more about products. In my world, Kelly, the intersection of Silicon Valley and Wall Street, Anthropic's Claude, it has been stealing every moment, but in particular, the Excel moment, something that should have been Microsoft's for the taking. And earlier today, you had Melius's Ben Reitz's, the Microsoft bull, saying that Anthropic's Cowork was something that a kindergartner could look at and go, wow, why isn't Microsoft doing that? OpenAI itself, it's been on the defense over the last few months, but its next frontier model, GPT-6, that is expected in the second quarter, and it's going to be trained on Blackwell chips. So that could put the narrative back in OpenAI's favor, but for Microsoft, it's more complicated. It will not get the same boost that it has got from OpenAI's Glow in the past.
Yeah, I mean, and to Brent's point, the quarter was decent, but investors are looking for this inflection point where the trajectory, it's like growing at a good pace is, I guess, not good enough anymore.
Right, especially when you compare it with Meta, right? And, we looked at these things and sort of this AI scorecard. How do you balance revenue growth with model performance, with adoption of things like Copilot versus, OpenAI's enterprise business? And there's a lot that goes into sort of who's on top of AI right now. And Microsoft, that dependence on OpenAI is taking a lot away from, certainty going forward. And that's what all the RPO chatter is about, is that actual durable growth? Are those contracts in the future? Could they go just to OpenAI simply because OpenAI, is now a major enterprise competitor, not to mention Anthropic?
All right, Deirdre, thanks very much. Appreciate it. Deirdre Bosa. To Dom Chu now for the CNBC News Update. Hi, Dom.
Hey, Kelly. So a federal appeals court ruled late Wednesday that the Trump administration acted illegally when it ended legal protections for hundreds of thousands of Venezuelans who were allowed to live and work in the U.S. The three-judge panel upheld a lower court ruling that said Homeland Security Secretary Kristi Noem exceeded her authority when she ended their temporary protected status. The Supreme Court will ultimately decide this issue. Maine Republican Senator Susan Collins said today that ICE informed her it has ended its stepped-up enforcement operation in the state after 5 days and 206 arrests. Activists tracking federal agent movements reported a big drop-off in activity in recent days, leading to speculation that the administration was rethinking its approach after a second American was killed last weekend in Minneapolis. And the European Union today named Iran's Revolutionary Guard a terrorist organization and sanctioned 15 Iranian officials over the deadly crackdown on nationwide protests recently. The sanctions add pressure on Tehran as the Trump administration moves the USS Abraham Lincoln carrier strike group into the region. So tensions on the rise in the Middle East. Kelly, I'll send things back over.
Quite the group, I don't know if it's an armada, but quite a group of ships over there now. Dom, thanks very much. Coming up, why this chart may be the real explainer of what's been weighing on the dollar and what it means for the metals trade. We'll reveal it next. And as we head to break, here are some of the names bucking today's downtrend and hitting new all-time highs. Lockheed, Caterpillar, Valero, Exxon, and Freeport-McMoRan. And Lockheed, which is up 5% today, is now up 30% this month. Its best month since 1980, believe it or not. We're back after this. Fed Chair Jerome Powell upgraded growth to solid from moderate in his press conference yesterday after the Fed's meeting. And he said the labor market showed signs of stabilization. Both of my next guests are still forecasting 2 rate cuts this year, but their timelines are quite different. Joining me now are Michael Gapin, Chief U.S. Economist at Morgan Stanley, and Barry Knapp, Director of Research at Ironsides Macro. It's great to have you both here. And Barry, I'll start with you. What's the significance around the Fed's action or non-action yesterday? And it doesn't have anything to, there's this weird move in the dollar and some of the metals this morning. I don't know if that's Fed related or at this point, if it's just highly volatile as a trade.
No, the dollar had a structural break with the market implied Fed policy path on Liberation Day. If you graph that near-term forward spread, the 3-month rate, 18 months forward, less the spot 3-month rate, sort of a proxy for expectations around what the Fed's going to do, it was super closely correlated, in 22, 23, 24, early 25, and then at Liberation Day, it broke. And the movement in the dollar now is, I think, the start of a secular change, the structural overvaluation of the dollar that in a lot of ways is attributable to our so-called trading partners' currency policies. There's all sorts of examples, things like Taiwanese insurance companies not having to mark their currency fluctuations on foreign bonds to market. Obviously China recycling all their surplus into treasuries. All those things are shifting, and I think the dollar is undergoing a secular decline. The big trick for Treasury Secretary Bessent will be making sure it doesn't get disorderly.
Okay, right? Thank you. And I think you're bringing it to the crucial point, because metals prices are acting like it's already disorderly.
Fair. The move in gold, I think there's a strong case for gold in as much as China's diverting a lot of their exports to the rest of the world. Their exports to the U.S. or our imports of Chinese products are down 43.5% year to date. We just got the November numbers this morning. So China's not accumulating dollars, which means they're accumulating, things like Mexican pesos, right? Importing to Mexico to divert it to the U.S. They're trying to divert exports to Europe. Mm-hmm. And they're putting that money into gold. But when it goes straight up like this, I was a trader. I worked in derivatives at one time. Yeah. You have to sort of go with what your prior guest, Chris Murphy, I think it was Chris Murphy, was talking about, that things just go parabolic and it gets kind of goofy.
But it's not, and Michael, I'll turn to you for this as well. You've all seen the narratives, right? The narrative is this is dollar debasement, it's fiat collapse. Pick who you think is responsible for that. But so I'm curious from your point of view, Michael, is this something worrisome? Does it raise on the margin the risk of import inflation? Because I'm pretty sure in the literature, when you use tariffs, your currency is supposed to appreciate, not depreciate, right? So if we impose tariffs, which raise import prices, and then the currency falls 10%, which further raises import prices, at some point, aren't we going to have an inflation problem?
Well, you do risk it. What's nice about the U.S. in that regard is the trade channel is pretty small. Their imports are not a significant contributor to inflation. So, if Barry's right and there's a secular move in the dollar, maybe you'll get some persistent upward pressure on import prices. But historically, it would be very unusual for import prices to drive inflation in the U.S. And I just say one other, what do I always have in the back of my mind about dollar weakness? It's the net international investment position of the U.S. The rest of the world holds $62 trillion in U.S. dollar liabilities. And so you can't recycle that anywhere else into another market. Of course, there's no other market that can handle that size. So you have to decide at what price you want to hold the dollar asset, and do you want to hedge? So I think, again, if Barry's right, we're in a secular downward trend in the dollar, and geopolitics are a concern, you need to hedge more. And that doesn't argue for a disorderly move in the dollar, but it could help fuel that weakening trend. So I do think the net international investment position here is something we need to keep in the back of our mind is what's also driving this.
Meaning it's the safety net, or we were just showing the euro, which is up near 120. It's not really getting a lot of attention. The European economy's been better. The European stock market has been better. The European central bank's already at 2% and not cutting anymore. And the shifting interest rate differentials have a lot to do with why the euro is stronger against the dollar. Michael, is that kind of what you're talking about, or are you referring more to the fact that there's so many people who need dollar exposure?
I just think that there are so many investors sitting outside the United States that hold dollar assets, right? So the rest of the world holding our equities and our treasury bills, and that position is $62 trillion, right? So if you were saying, oh, I don't like what the U.S. is doing, I want to sell dollar assets and rebalance somewhere else, there's no market that can absorb that, right? So you have to hold dollar assets. But so if you're a foreign investor and you've held equities, normally, if there's a risk-off moment, the dollar appreciates. But right now, that correlation has flipped. So now you need to hedge your portfolio. So I just think it's the relative positions where the U.S. holds about $36 trillion in foreign assets. The rest of the world holds $62 trillion in our assets. And if the correlations change and you now need to hedge dollars, then it's going to put a lot of persistent downward pressure on the dollar.
I see. Interesting. And why has it changed, Barry? What happened with Liberation Day? Was it the tariffs?
Oh, it goes beyond the tariffs. I strongly suspect that in every one of these trade meetings, the unspoken piece, or a piece that they've agreed not to speak about, is that Treasury Secretary Bessent is applying pressure, saying you are not going to do what China did when we enacted 10% tariffs in 2018, depreciate your currency by 10% and offset those tariffs. I think there's a lot of pressure on the rest of the world to not take those steps. And one piece of evidence of that was the almost impulsive appreciation of the Taiwanese dollar back in, I think it was early July. It just kind of shot up, and that was during those trade negotiations. So I think we're making it very clear that we're not going to accept, putting tariffs in place and then having countries trying to depreciate their currency through various policies away from that. I would also add to what Mike said, which is, really profound. If you run a current account surplus, by definition, if you have an open capital account, you have to run a capital account deficit. So Europe is still running a current account or trade surplus with the U.S. I looked at the numbers today. It's going up sharply in Ireland. Well, guess why that's happening? Those are U.S. companies doing transfer pricing-based tax arbitrage and accumulating those assets in Europe. Germany's deficit is going down. That's selling cars to the U.S. But that money, if there's a current account surplus, or deficit surplus with the U.S., means they need to have a capital account deficit that needs to offset. So the money winds up in the U.S. one way or another, unless, as I said, over time, if the U.S. trade deficit does enter into a secular decline, which it did in the 70s when Nixon took similar actions as the Trump administration, we could be in for something similar, in this cycle, and that would reduce demand over time. But again, as Mike said, there's really nowhere to go with that 62 trillion of assets.
Right. So we got to go, Michael, but there's no fundamental concern about the quality of the U.S. then? Just quickly.
Well, I think there's concern about where the U.S. is heading from a policymaking perspective, right? So I do think whether it's fiscal sustainability, protectionism, trade policy, geopolitics, there's increased country risk from the point of view of a foreign investor on the U.S. I do think that's part of the story.
Fascinating. We got to bring you both back. It's like we're just starting, but there's more to come. We've got some news to get to. Michael Gape and Barry Knapp, really, really appreciate it. Thank you for your time. We were talking Tesla earlier on, but we've got a news alert on two of Elon Musk's other companies. Dom Chu, what's happening?
Well, one of which, Kelly, is probably going to be one of the most highly anticipated public offerings in the future here. We're talking about SpaceX. So this is according to a Reuters report citing sources familiar with the matter. They are reporting that Elon Musk's SpaceX and xAI, those two separate companies, are in right now discussions to merge ahead of a possible public offering planned for later on this year. Again, that's according to a person briefed on the matter. Now, this is interesting only because it would be a transaction in which shares of xAI would then be exchanged for shares of SpaceX ahead of this particular anticipated IPO. So an interesting development here with regard to two of Elon Musk's probably most public companies in terms of, maybe its overall view, but, not the public ones like Tesla. An interesting move there. We're showing you some of the valuations in the private markets right now, Kelly. We'll bring you more as we know more. We are in the process of reaching out to both SpaceX, and xAI for comment. We'll bring you those updates as we know more here. Kelly, I'll send things back over
Appreciate
to you.
it, Dom. A lot of speculation about not just those two combining. Could it ultimately be combined with a Tesla down there? Who knows? We'll see. He's always full of surprises. Dom, thanks. Coming up after last night's earnings reports, shares of Meta are up, but shares of Microsoft are down. They are, in fact, on pace for their worst day since March of 2020 and shaving more than 180 points off the NASDAQ 100. Next to report is Apple after the bell. We'll tell you what those expectations are after the break. Welcome back. We've got another quick news alert. This time it's on the prediction markets and the Super Bowl. What could it be, Contessa Brewer?
Are you ready for this?
No.
What do prediction markets have in common with sex and smoking? Front Office Sports Report says prediction markets have been put on a prohibited list from running Super Bowl ads. And Front Office Sports points out that pornography and tobacco are also on that list. Incorrect was the word an NFL spokesman said when I called to ask about it. NFL considers prediction markets gambling. The NFL has 3 official partners. They have Caesars, FanDuel, which is owned by Flutter, and DraftKings. They also have approved sportsbook operators. So, for instance, Fanatics this year has bought time and will run a Super Bowl ad. The NFL says that's an approved operator, an approved sportsbook operator. Those are the only categories. The NFL spokesman says, look, prediction markets like Kalshi and Polymarket are neither approved partners nor approved sportsbook operators. Therefore, that is why they can't have gambling ads on the Super Bowl, at least not this year. What happens between now and next year, let's wait and see.
So prediction markets can advertise?
They cannot.
They cannot.
Because they are not, but not prohibited. And that's the point. They've not been banned. They just don't, because they're considered gambling, this is from the NFL, they can't advertise because they're not official partners and they're not approved sportsbook operators.
I see.
However, as you know, Kalshi and Polymarket say, well, it's not gambling, it's financial investments, and that's what they're arguing in federal court. So between now and next year, we may get some answers from federal court, maybe even Supreme Court, about what's what.
In the meantime, they better act fast on those ads. Contessa Banks, Contessa Brewer. Speaking of, I don't know, Apple reports after the bell today. Strong iPhone numbers are expected, although its AI plans also remain in focus. Steve Kovac is in Cupertino. Steve, where, I mean, if hardware is the new software in the markets, they are a hardware company, so maybe they need to play down the software narrative and stop talking about that.
That's very possible, Kelly. And look, it is going to be a big quarter for the iPhone. That is what Apple guided to last quarter, saying to expect double-digit percentage revenue growth, top-line revenue growth. We haven't seen that in the December quarter in quite some time here, so we already know that's kind of baked in. The big question is, of course, a couple weeks ago, that big partnership announced between Apple and Google's Gemini product. It's going to be sort of baked into that new version of Siri we're expecting in about a month or so, and whether or not that can be monetizable. But again, to your point, it's a hardware play, not a software play, because Apple Intelligence is a free product. It comes with the phone that you buy. And so the real way they're going to be able to monetize this, at least at first, is going to be from convincing people to upgrade their devices to use Apple Intelligence. Down the road, maybe there's some more monetization there. Also, another thing we're going to be watching is the tariff impact. Apple said to expect about $1.4 billion of a tariff bill for that December quarter due to the high volume of products they sell. And then also memory prices. There's been a lot of consternation on the street and analysts talking about this and how that could impact margins here at Apple, just because memory is getting so expensive as with AI competition, Kelly.
All right, that's what I'm definitely going to be listening for. See if they talk more about that. Steve, thanks. Appreciate it. Steve Kovac.
Thanks.
Coming up, the latest from Starbucks Investor Day. Some fresh details right after the break. Starbucks is holding its investor day after the shares failed to hold their rally after results the other day. But Kate Rogers is there and has new content from the CFO. Hi, Kate.
Hey, Kelly. So the financial guidance that was given today was really what Wall Street has been waiting for. We'll take you through the numbers now. In 2028, Starbucks has plans for 2 to 3% revenue contribution from new stores, 2,000 more new stores, including 400 here in the U.S. Also forecasts consolidated net revenues growing by 5% or more in fiscal year 28 and operational margins between 13.5% and 15%, which means $3.35 to $4 a share by fiscal year 2028. Now, some of this margin expansion includes targeted pricing, mostly to offset inflation. I asked CFO Cathy Smith specifically about that targeted pricing and what it might mean. Take a listen.
I'll start with margin growth is first going to come from probably not pricing for us. Pricing is going to be our last lever. Having a great value perception by our customers is really important. Our value scores are kind of back at all-time highs now across all age groups, which is terrific. So we want to use price very selectively, only raise price when we have to.
So you can hear there, Kelly, targeted pricing only when necessary, and that global comp and the U.S. comp for 2028, 3% or more. Back over to you.
Kate, thank you very much. We appreciate it. Kate Rogers, then Power Lunch after a break.
Microsoft mucking up the market and your money. I said mucking. Welcome to Power Lunch, everybody, with Kelly. I am Brian. Big moves in the market today. Microsoft saying OpenAI is costing it billions, and oil rising as the real risk grows of a U.S. attack in Iran.
And Microsoft is not the only tech stock under pressure. It's a lot of the software names, the whole complex. ServiceNow is falling double digits after their quarterly results. It's weighing on the whole software space. HubSpot, Atlassian, Guidewire, Workday, these names are all hitting 52-week lows today. Even in Germany, SAP was weak. Everywhere you look, software is a trouble spot. Let's begin with Microsoft, which our next guest owns and says this is still a great opportunity to buy. Jim Tierney is CIO of U.S. Concentrated Growth at AllianceBernstein. Jim, it's great to have you. So is it a software problem? Is it about OpenAI kind of maybe being on the back foot here relative to Gemini? Does it matter?
I think relative to Microsoft, people are missing the big picture. And the big picture is this is a company that is growing substantially. Numbers are going up, not down. And the multiple is now corrected 12% today. So I think it's a great opportunity to get involved for those that aren't.
Okay, but I guess then what you're saying is this is a short-term concern weighing on, those, and you're kind of in the camp that Microsoft's going to figure it out. I mean, Brent Thill last hour said the problem is not that their results were terrible or anything like that, but they don't have the same growth inflection point that you can find elsewhere in the tech space right now. Does that matter to you?
Of course it matters, but I think you have to look at the absolute numbers as well as the relative numbers. And the absolute numbers were 38% growth for Azure in the quarter, and next quarter, the March quarter, is 37 to 38. They have a capacity problem, not a demand problem. We saw the exact same movie a year ago, and then capacity came online and growth accelerated. So I think we're going to see the same thing. Maybe it'll take another quarter or two, but then you see another wave of growth. So I think people are missing that big picture, that this is not linear. It comes in waves. And maybe you could try to be cute and trade who has the capacity coming on versus who's capacity constrained. But I think you're missing the big picture in that this is a great growth industry and will be for years. And Microsoft's a really fantastic way to play it.
Yeah, and Microsoft has made investors a ton of money the last few years. Satya Nadella and team, they've done a great job. Nobody doubts that. I will add some interesting stats that our team plucked out, Jim, that Microsoft today is losing more value today than the entire value of Bank of America.
Wow.
OpenAI. There's a lot of questions around the company. Are you worried about Microsoft's multi-billion-dollar investment in OpenAI?
I don't think Microsoft is solely OpenAI, and I think that's one of the things that investors need to understand as well. They have a lot of their own initiatives. The Silicon venture or Silicon effort that they talked about sounds pretty interesting as well. So it's not just OpenAI, and there's more to the Microsoft story than just OpenAI.
Yeah, but do you worry about the fact that they're so heavily invested in OpenAI? Looking at the second quarter numbers, it was a $7.6 billion, non-GAAP write-down from OpenAI from last year. That's not a lot, fair enough, compared to Microsoft's size. But do you worry that their investment in OpenAI is risky, or as an owner of the stock, you are comfortable with that?
It's 100% a risk factor from the perspective that Microsoft has more exposure to OpenAI. We don't know who the ultimate model winner will be, if there will be just one winner. We tend to believe there will be more than one winner, and each model will have specific uses. So we don't think it's an all or nothing. It's certainly important that OpenAI stays relevant for years to come.
Would you, Jim, be a buyer of all these other software names, or any of them in particular here?
We have plenty of exposure here through Microsoft, and I think that's the bet that we're making. The real question is, how is AI going to disintermediate business models? And that's still on the come. What we're seeing is the likes of Microsoft and Amazon and Meta using AI to reduce labor input, getting so much more efficiency. So that's wonderful for them. The question is, what's the next step? And I think that story has not really been written with other software companies. And there are going to be companies that have their businesses challenged here.
So you have exposure to them, but you wouldn't necessarily be increasing any of that exposure here as they're trading at 1 year and in some cases multi-year lows.
So our primary exposure is through Microsoft, and we're really comfortable with that. You pick and choose, and I think what today is telling you is to be selective. And not everybody's going to do well here. So being selective, I think, is the approach that investors have to take going forward, as opposed to the last couple of years where all boats were rising.
Understood. And I mean, there's so many other bright points in the market right now. We talked about energy as the standout. Lockheed Martin's having its best month in 30 years. There's the weaker dollar, which is in many ways supportive for stocks as long as it doesn't become disorderly. So do you generally feel positive about the whole environment, the whole complex, the broadening out of the move as you look at it?
Absolutely. If there was one thing that we learned last night is that CapEx is going through the roof. So the question is, who are some of the players, who are some of the companies that are exposed to those CapEx trends? So you look at a company like Amphenol or a company like Eaton, both in our portfolio, they are very positively exposed to that capital spending. And again, what we heard last night is that capital spending is not inflecting down. If anything, it's inflecting upward. So there are some huge beneficiaries. And as you said, the market is broadening. And I think that's an important trend for investors to recognize. It's not just 7 stocks anymore. There's a whole lot more in the market that can make you really nice returns.
Yeah, because I know you are not a Meta investor, Jim, but you must have liked their capital spending news. They basically increased their planned investment in AI and infrastructure around it by 70%, 70%, Kelly, to $115 to $135 billion. Now, my question is, where are they getting that money? Out of debt, out of private, who knows?
Out of profits, if the way things are looking.
They don't. That's a lot of money.
Yeah.
That either way, though, Jim's got to be he's smiling, got to be happy with that investment. Also, talk to us about what was your largest holding. Maybe it still is. MasterCard. You're not worried about the consumer at all. Otherwise, I assume that wouldn't be your top holding.
MasterCard had a very interesting comment today, which is consumers fill out a survey and they say one thing, and then they go to the store and they say something completely different. And when you look at the spending trends, they've been very consistent fourth quarter into January. So the consumer continues to spend. MasterCard is a global business, so it's not just U.S. consumers. And then they have a value-added services business, and that grew 26% on a reported basis, about 19 or 20% on an underlying basis. That's spectacular growth. So it's not just U.S. consumer spending, but it's global spending as well as services that they're putting around transactions, and really good story. And again, a stock that's been beaten up year to date around worries about what's happening with crypto and stable coins and agentic
Swipe
commerce.
fees.
These results are fantastic.
Yeah, so the president, the legislation, what is it called? The Swipe Fee Competitive Act or what have you? You're not worried about that?
Great. Credit Card Competition Act, certainly it's something to pay attention to, but when you really break it down, if it happens, it's on a portion of their business, basically U.S. credit transactions. That's a much smaller part of the business than people realize. And if you introduce competition, it doesn't mean that business goes to zero. There are lots of ways that MasterCard can make money. So this is a stock that traded down 7 or 8% over a couple of days early in the year when this came out and got new notoriety. I think the stock has a whole lot more to go to recover some of that, particularly as the risk of the CCCA seems to be fading a little bit here.
They say one thing, they do another. The perennial...
I'm never going out to eat again as they're out to eat, swiping that MasterCard.
Tomorrow my diet begins.
Yeah, free beer tomorrow.
Only chicken from the grocery store. Jim, thanks very much. Appreciate it.
Thank you.
Jim Tierney with AllianceBernstein.
All right, now let's get to the market story that's not named AI, and that has really been Japan. If you've been listening the last few months, you know that Rick Santelli's been all over this story, as selling in Japan also impacts our markets here and keeps bond yields and borrowing costs, maybe to some, stubbornly high. Rick Santelli joining us. Do you like that intro, Rick? Giving you the shout out about Japan, baby.
No, and I love that intro. And, to that end, control room, let's show a chart of going back to the last century of those 10-year yields that you just showed a 1-year chart of, because we have to go back into another century to find yields as high as they are right now in Japan. And also notice how much action on that chart is below zero. And why should interest rates ever be below zero? Manipulation by central banks. So it's an easy story to put together. Yes, it's keeping interest rates high, but what it's really doing is underscoring how central banks have behaved and how the market doesn't like that. And how's that showing up? Just look at gold prices. So it's all really part of the same story. It's a normalization. Did everyone really think that we in Japan in particular, but all the advanced economies, were going to get away with issuing all this debt, manipulating interest rates to issue more debt and keep the servicing costs down and get away with it forever? I don't think so. One other thing I want to point out is that we really want to monitor what's going on in gold, because the price of poker goes up, folks. I traded gold the last time it was crazy, 79, 80, 81. And when you start to get these ranges, you see that correction we had this morning? Get used to more of that type of volatility. Finally, let's go to the bond market. Pretty much it's been in a range, but just like this story, you see that 10-year, that's a 4-month chart. It is slowly starting to get above its very long range we've been in. Unlike the 2-year, which if you overlay it, is still really hasn't broken out. And why is that significant? Because the move in 10s is like in slow motion. We broke out with a close over 420. We go up to 430. About a week later, we come and test the old range at 420, and we move back up. If we don't trade under 420 on a Friday close, weekly closes, a priority technical, I really do think we're going back into the mid-430s. Kelly, back to you.
So much. I mean, I totally agree about the metals. Buckle up and get used to it after the moves that we've seen. Rick, thanks. So whether it's Meta, Microsoft, or any of the other AI hyperscalers, as they're known, they are all in need of huge amounts of power for these data center ambitions. How is that demand going to be met? Morgan Stanley's head of power and utilities will tell us next.
All right, there's something happening right now in the stock market that maybe Kelly can, I can't recall ever happening before. A 20% price difference today between Microsoft and Meta. Meta's soaring. It's up over 9% after a dramatic boost in its planned AI spend. It'll raise its investments 70% from last year's totals to between $115 and $135 billion. The flip side, Microsoft, down about 12%. It showed non-GAAP energy. And right now, there's seemingly plenty of one, but maybe not enough of another. And your next guest has a 102-page new note out on just this, with the fourth
All right, guys, I'm going to go ahead and wrap up the day. That's all for the day. Thank you, guys, and I will see you